Very good morning, friends. So I hope you're all doing well. And most importantly, I guess you've been doing a cumulative revision on financial instruments. Well, we are talking in terms of Index 109. And I think before I take forward the journey, we were discussing the concept of derecognition of financial assets with you. I think, first of all, I'm going to answer those small little MCQ questions to you, which I gave you in the previous class. And then we'll go forward with the concept of derecognition with you. So I think let me first start with those 5 questions which I gave you in the previous class. Well, first of all, if you remember, we were talking in terms of a cash flow test. And the first question is that the cash flows have been transferred, and the risk and reward test also tells me that it is being substantially retained. So that means step number 1 is met, and the step number 2, technically, I would say, is given evidence that it is risk and reward is substantially retained. Then I said that the accounting is that you continue with the financial asset in the books of accounts. And that's absolutely correct. Then the second one combination which I gave you is that if the cash flows have been transferred and the risk and reward is being substantially transferred, that means the step number 1 passes, the step number 2 also passes. In this particular case, I gave you that there is going to be a full derecognition, and that is also correct. So the first statement is true, the second statement is also true. Then there is a third statement, and yes, I'm getting good answers from all of you. Wonderful indeed. Then in terms of these, question number 3, the cash flows have been transferred and the risk and reward tells me it's neither substantially transferred nor substantially retained. In this particular case, I've written it's a case of a partial derecognition. Well, if the risk and reward test tells me that it's neither transferred substantially nor retained substantially, we need to go to the control test. We cannot decide any kind of accounting at this stage. So the third one is supposed to be false in nature. Then the fourth one, I gave you that if the cash flow test tells me that it is expired, then I said we continue to show the asset in the books of accounts. And I think this is again false, because if the cash flow test is expired, then there is no further assessment required and a derecognition would directly take place. So the fourth one is also false. And then finally, in the fifth one, I give you a question not on a derecognition, but on a financial guarantee. And I said, when you are looking at the computation of a financial guarantee on a subsequent basis, we need to consider the lower of the two, that is the amount of loss allowance or the value which is computed using an amortized cost accounting. So I said we take the lower of the two. And I think if you remember, it is supposed to be the greater of the two and not the lower of the two. And that's again right, Rashmi, absolutely. This is again false. So I think all simple, straightforward questions indeed. Okay, so I think that answers the questions which I gave you in the previous class. Now what I am going to do, I am going to quickly give you a recap in terms of the derecognition concept, what we're doing. And then I need to take you to the accounting for a derecognition of financial assets. So what's the agenda for the day? We're going to first of all discuss the accounting for derecognition of financial assets. Then I'm going to come to the derecognition of financial liabilities accounting. Then we're going to discuss the accounting as far as derivatives and embedded derivatives is concerned. Okay, and if the time permits, which I don't think so would permit, we'll come to the concept of impairment and hedging, but that's more an agenda which we're going to cover in the next class with you. Okay, so let's, I think, begin the journey and start talking in terms of derecognition. What I gave you for financial assets, let me remind you, we are focusing on the derecognition of financial assets at the moment. Now, I said that when you're looking at a derecognition of financial assets, there are certain parameters on the basis of which a derecognition takes place. Now, since we've already known what are the kind of tests, we can get it more easy. So I gave you a simple 3-step model in terms of deciding whether a derecognition of financial assets can take place or not. The first test is what we called a cash flow test, and which has got a total of 3 sub-steps. Mind the words carefully. This has got a total of 3 sub-steps. Then the second one I give you is the risk and reward test. And in case of risk and reward test, there are no sub-steps, but there are basically 3 possibilities. Mind the words very carefully. I'm saying in step 1, there are 3 sub-steps, and in the risk and reward test, there are 3 possibilities. And then finally, in the step number 3, which is supposed to be the control test, in this particular case, we've got 2 possibilities. There are no sub-steps. It has got 2 possibilities. Now, when you consider the step number 1, that is the cash flow test, we put across a question to ourselves: has the cash flows expired? Now, when I say the cash flows have expired, this means that whatever you were contractually, you got a right to receive, you've already received the money. So basically, I said that you should be given the status of a full and final settlement, F&F. So if the cash flows have expired, and if you say the answer is a yes, then it's time to derecognize the financial asset. But if the answer is a no, you need to go to the sub-step number B. And you need to see that the cash flows might have been transferred. And when I say that the cash flows have been transferred, this would be a case when you either sell the financial asset. A sale of the financial assets would lead to transfer of the cash flows to another party, because contractually the asset is still going to give you cash flows, except that you have transferred those cash flows to another party. Or it could be a case of assigning your trade receivables to a factoring agency for that matter. If you say that the cash flows have been transferred, then you go to the risk and reward test. But if you say the cash flows have not been transferred, then you go to the sub-step number C, and you say whether it's a case of a pass-through arrangement, which has got a total of 3 conditions to be met. Because if you say that it is a pass-through arrangement, you need to basically prove, number 1, that all the cash flows will be transferred. So you can say as and when they arise. So whatever arises is given, and whenever it arises is given, and you cannot sell, you cannot pledge. So if you prove that yes, the PTA 3 conditions are met, you go to the risk and reward test. And if this fails, then you cannot derecognize the financial asset. So it's a sequential step in terms of the cash flow. And then when you go to the second step, risk and reward, either you say that the risk and reward is being substantially transferred. The word is very clear that it is substantially transferred. Or you say it is being substantially retained. Or you say it's neither substantially transferred nor it is substantially retained. Now, in a situation where you say that it is being substantially transferred, then you go in for a derecognition. And it's a full derecognition. And if you say that it is being retained, then you need to continue the financial assets in the books of accounts. And this is the case where I said that you would recognize a financial liability. Since the financial asset is not eligible for derecognition, you'll have to basically recognize a financial liability in this case. And if it becomes a case of neither substantially transferred nor retained, you need to go to the step number 3. And in terms of the step number 3, you would now put across that the control is being transferred or is it being retained. So the control is transferred when the other party has got the practical ability to sell the asset further. And it is retained if he has got no practical ability to transfer, to sell that asset further. So if you say the cash flows, the control is being transferred, then it's again a case of derecognition, which is again a full derecognition. And if it is a case of retained, I said it's a case of a partial derecognition. So basically, in this particular 3-test procedure, we looked at the permutation combination, that if you're looking at the kind of accounting which stems out of the various permutation combinations in this case, we can say that typically there are 3 kinds of accounting. One is a case where it is a case of a full derecognition. That is, for example, if you meet the cash flow test expiry, or if you meet the cash flow test and the risk and reward has been substantially transferred. So we can say the case of full derecognitions would arise in various cases. A cash flow test is met. That means the cash flows have expired, or the cash flow test is met and the risk and reward is also transferred, or the cash flow test is met, the risk and reward is not transferred substantially, not retained substantially, but the control test is met. The second kind of accounting which stems is the case where you need to continue the financial asset in the books of accounts. And this, as I said earlier as well, leads to a creation of a financial liability. So no derecognition at all. So when you say continue the asset, it's a case that there is no derecognition and the financial asset needs to be continued. This would typically be a situation where we are saying that the cash flow test is met, it's been transferred, and the risk and reward is substantially retained. So in this case, you would see only one combination arising when the cash flow test is met and the risk and reward is substantially retained. This would be the case where you would continue to show the financial assets in the books, and the consideration received is going to be technically recognized as a financial liability. And the third accounting which stems out of this is the case of a partial derecognition, which is again only one permutation combination, and that is the cash flows have been transferred, the risk and reward is neither been substantially transferred or retained, and the control is also retained. So in that particular case, a partial derecognition would apply. So remember, when you're going to do a practical question on accounting for a derecognition, very carefully, first of all, identify which combination is getting met. Because depending upon the combination, you would apply the full derecognition accounting or a continuation of financial asset accounting or a case of a partial derecognition. So I think this was a summary in terms of what I gave you. So these were two aspects. When I started my discussion in the previous class, I gave you basically two aspects in terms of things, but there is a third aspect as well. So one area of discussion is the parameters which leads to the conclusion whether we derecognize the financial asset completely or partially, or we continue to show the financial assets in the books of accounts. The second area of discussion is the accounting. And then there is another third area also which we need to discuss, and that is, do we derecognize a part of the financial asset, or do we go in for 100% derecognition? This is something which we're yet to discuss, that what are the cases when a derecognition will take place fully for the asset, or maybe a component of the financial asset is derecognized. So that would come later. Let's, I think, now concentrate in terms of the accounting now. So what I'm going to do, I'm going to now take you to a few questions and where we're going to connect in terms of the permutation combinations, that what kind of accounting will get triggered. And then we'll see that how the accounting for these three cases will take place. I guess we've got a good recap in terms of things. Now, I think let's take the journey forward. Okay. So let me, I think, come back to the study material. I'm looking at the unit number 5. And in unit number 5, we are given 3 sections within the accounting. So page number 12.157. And you can see the very first case which says transfers that qualify for derecognition. Now, before I take this illustration number 11 with you, I think let me give you another chain of thought very clear. So in this case, I told you that if the cash flows have expired, that is one combination. If the cash flows have expired, there is one combination. Second, if the cash flows have been transferred, plus the risk and reward test is substantially transferred, that is another combination. And number 3, the cash flows have been transferred. The risk and reward is neither substantially transferred nor substantially retained, plus we can say on the control test it has been transferred. Can I say in all these 3 permutation combinations, would you like to tell me what kind of accounting would apply? A full derecognition, a partial derecognition, or is it a case of a continuation? Look at the 3 combinations carefully. Either we say the cash flows have expired, Or we say the cash flows have been transferred and the risk and reward is also substantially transferred. Or the cash flows is transferred, the risk and reward is neither substantially transferred nor retained, and the control test is also transferred. So what kind of accounting would you apply? Wonderful indeed. That's right, Koshki. That's right. Absolutely. Soham, wonderful indeed. So I think we can definitely decide that this is a case of a full derecognition. Wow. Very happy to get the answers, because now this means that we're able to connect in terms of the parameters of derecognition and the accounting as well. Because many a times I've seen that, students are not able to get the connect in terms of the parameters and the accounting. Some cases I've seen people directly jump to the accounting without even understanding the parameters. So now I'm going to take you to the illustration and we're going to see which permutation combination is getting met. So let me come to the illustration number 11, which is on unit number 5, and that's page number 12.158. So I'm looking at the study material page 12.158, and this is illustration number 11 in unit number 5. Let's, I think, read and identify in this particular case what permutation combination is getting met. It says ST assigns its trade receivable. The moment I read the word assigned its trade receivable, what comes to my mind is that the cash flows have been transferred. The carrying amount of the receivable is 10 lakh and the consideration received in exchange is 9 lakh. The customers have been instructed to deposit the amounts directly into the bank account for the benefit of the factoring agency. So the customers were given a direction that you directly deposit the money in the account of AT receivables, which is the factoring agency. And AT has got no recourse. I like it. And if AT has got no recourse, that means risk and reward is being substantially transferred. And it says, in case there are any shortfalls in collections, state whether a derecognition principles will be applied or not. So I think if I come back to this analysis, if I look at my step number 1 and I say that the cash flows have expired, then in this particular case, I'll say no, the cash flows have not expired. Then I go to the next case, I say, okay, the cash flows have been transferred. I said, yes. They've been assigned to a factoring agency. It's a case of transfer. Then I go to the risk and reward test and I said, it's a case where there is no recourse. And if there is no recourse, then we can definitely say that it is being substantially transferred. And if it is being substantially transferred, then can I say in this particular case, this is the combination, right? We can say that out of all the 3 permutation combinations I gave you, can I say it's a case where the cash flows have been transferred, the risk and reward has been substantially transferred. So we can give a conclusion on the accounting that the conclusion in this case is go in for a full derecognition in this case. I think if you've been able to catch up with the analysis, then I think your fundas are working very, very good. Super. So I think, let me see if you got the correct answer. Yes, that's right. Shubham, that's right. Manani, that's right. Koshki, absolutely. Wonderful indeed. Right, Nidhi, wonderful. Super. So in this particular case, it says whether a derecognitions will be applied or not. Yes, a derecognition would apply. So can I say I would be in a comfortable position to put the entry, bank will be given a debit to the extent of 9 lakh. The financial asset will be given a credit to the extent of the book value, which is 10 lakh, and the balancing figure becomes a gain or loss on derecognition. So if you look at the answer, it very clearly says ST transferred the rights to contractual cash flow and has also transferred all the risk and reward of ownership. And accordingly, it derecognizes the financial asset and recognizes the difference between the consideration received and the carrying amount as an expense in the P&L. So if I were to give a journal entry with regard to the full derecognition, the entry which I gave you last time as well, the bank will be given a debit to the extent of 9 lakhs. The financial asset will be given a credit to the extent of the book value, since it's a full derecognition, and any balancing figure in this particular case is going to be taken in the profit and loss account. So 1 lakh is the loss on account of derecognition. Now, at this stage, technically illustration 11 is done, but I think I want to give you a little more insight in terms of this accounting to get a little more clarity of thought. Now, let me tell you that we cannot forget the earlier concepts we have studied as well when you're looking at a derecognition of financial asset. So let me now remind you that when there is a financial asset, it may be measured in the books of accounts at AC. Let me now ask you, as far as a debtor is concerned, because we're looking at a debtor, which is a trade receivable, can I say it would be a case of amortized cost accounting? So that means a trade receivable would have been recorded in the books of accounts at amortized cost. So we are indirectly looking at illustration 11, which is a case where the financial asset is measured at AC. But there could be other cases as well when it is measured at FPTPL or it is measured at FPTOCI. So now, just to remind you once again, that if you are considering the case of FPTPL, can I say in this particular case, the gain or loss will be taken to the P&L? And in terms of FPTOCI, can I say it depends? In terms of FPTOCI, it depends if you're looking at NR or you're looking at R. Just to remind you, if you're looking in terms of NR, the gain or loss will be taken in OCI and not in the P&L. And if it is a case of recycling, then it would be taken in the P&L. And we also need to remember that if it is a case of OCI, which is no recycling, and a case of recycling, even the accumulated balance in the SOKI, because whatever amount was transferred in terms of OCI year by year, and it got accumulated in the statement of changes in equity in tab number 3, can I say in terms of no recycling, it will be directly transferred to retained earnings. It will be directly transferred to the retained earning, whatever accumulated balance is there. And in terms of recycling, what you'll have to do, you will have to root it in the profit and loss account. I think, let me put this once again. This is something we discussed earlier when we were looking at the measurement of financial assets initially and subsequently. So the illustration number 11 is the illustration which is devoted to that the trade receivable, the financial asset, is being measured at amortized cost accounting. So any kind of profit or loss which arises on a derecognition is being taken in the P&L. But you need to be careful that if you get a financial asset which is measured at FPTPL, there also the gain or loss is going to be taken in the P&L itself. But if you get a financial asset which is measured at FPTOCI, you need to watch out that is it a case of no recycling equity investments, or is it a case of recycling that is debt investment? If it is a case of no recycling, then the gain or loss will also be taken to the OCI and not to the P&L. And if it is a case of OCI-R, the gain or loss will be taken to the P&L. So the only exception which arises is the case of OCI-NR, where the gain or loss on a derecognition would go to the OCI and not the P&L. So that is one thing which need to be careful on. The second is that in terms of OCI, whenever you transfer the amount to the OCI annually, you keep accumulating that balance in the tab number 3 of SOKI. So that accumulated balances which are there in terms of tab 3 SOKI, if it is a case of NR, it will directly be transferred in the retained earnings column and transferred to the tab number 2. But if it is a case of a recycling, then it is to be rooted in the profit and loss account as well. So if a question comes in the exam, you also need to tell the examiner that the accumulated amount in OCI, is it to be directly transferred to RE, or is it to be first transferred to the profit and loss as well? Right? I guess I'm making sense on that. And Shobham, you said, I think, so expenses to be under the head finance cost. Expenses, I didn't get you. Which expense are you talking of? Okay, you mean to say that this difference of 1 lakh rupee, well, this is a profit loss on derecognition. So it would be appearing as a separate line item. Because in any case, the format of the income statement P&L in Schedule 3 is not an exhaustive list. So it's not going to be clubbed as a part of the other expense. It can be shown as a separate line item as well, depending upon, of course, the materiality of the figure as well. Right? Okay, so this was the first case where we saw that there is a case of a full derecognition. So where do you take the profit or loss on derecognition? So we can say it's going to be taken in the P&L except in case of OCI NR. And you would remember the accumulated balance of the OCI, what is to be done at the time of derecognition. Okay, now let's, I think, take it further. And let's now go to the next illustration with you. Now, there is no illustration which is given in terms of the second area when the financial asset continues. But I think we can just have a little read in terms of what kind of accounting would occur. Now, if you look at the second section, transfers that do not qualify for derecognition in the study material, they're very clearly given that you continue to show the transferred asset in its entirety. So once the financial asset cannot be derecognized, you need to continue the asset in the books of accounts. But it says recognize a financial liability for the consideration received, which is taken at a fair value less any TC. The liability is then subsequently measured at AC using an effective interest method. Now, let's take an example on our own. I think let's do one thing. Let's take an example on our own. So I'm now looking at the second kind of accounting. I'm now looking at the second kind of accounting. So let's see the permutation combination. Can I say in this particular case, the cash flows have been transferred and the risk and reward test is being substantially retained? Can I say this is the only case where the financial asset will continue in the books of accounts, right? There cannot be any other permutation combination. So we can say if the cash flows have been transferred, you pass the cash flow test, and the risk and reward is being substantially retained. This is the only case where the financial asset continues to appear in the books of accounts. And I think we can now consider an example. Let's say, for example, I am considering a discounting for a bill of exchange. So when you discount a bill of exchange, so a bill receivable is, let's say, discounted. Then in this particular case, I would say, yes, the cash flows have been transferred. And a bill of exchange would always be a case where there would be a recourse. Because when you get a bill of exchange discounted from a bank, it will always have a recourse that if the other party fails to pay the money, the bankers would always make the company liable. So we can say the risk and reward is substantially retained. So can I say comfortably in this case, the accounting which would follow in this particular case is going to be bank account debit, and you create a financial liability. So can I say this will be the net amount received? That means post the discounting charges, which means what you used to do in school level in terms of discounting a bill of exchange, putting the entry bank account debit, discount account debit to bill receivable. Can I say now the new entry becomes bank account debit to financial liability? So whatever is the net amount received, you're going to put that entry. So it becomes a very simple accounting. And then this financial liability, which has been created in the books of accounts, can I say in this particular case, it is going to be initially measured at a fair value, less TC, and that's the basic principles we have in mind. That when you recognize a financial liability initially, it is always taken at a fair value, less the amount of TC. And then subsequently, this is to be recorded at amortized cost accounting. So the financial liability, which will be created when the financial asset is not eligible for derecognition, mind the words. When the financial asset is not eligible for derecognition, you create a financial liability initially measured at a fair value minus the transaction cost and subsequently taken at amortized cost accounting. Wow. So I think that takes care of my second kind of accounting as well, though we don't have a practical illustration on this, but I think the accounting is very simple and straight indeed. Okay, so I think that takes care of my second combination. And yes, Koshki also told me, so a case of PTA as well. Shobham also tells me, wow, that's absolutely correct. Though I think I didn't make a mention on that because I thought it might get complicated, but you very rightly pinpointed that yes, it is a situation where the cash flows have been transferred or it is a case of a PTA, correct. So that would be there in the first combination as well, technically speaking. Because in this particular case also when you say the cash flows are transferred or maybe it's a case of PTA and the cash flows have been transferred or maybe it's a case of a PTA. So I think that combination follows in all cases. Wow, wonderful to see that. So my first accounting is done, complete derecognition. My second accounting is done, that there is no derecognition and you continue to show the financial asset in the books and you recognize a financial liability. Now we come to the third one, which is a slightly complicated accounting, and that is a case of a partial derecognition. And the only situation when a partial derecognition would take place is what? Let's look at the permutation combination. Can I say the cash flows have been transferred? And I think now, since you know, or it is a case of a PTA, and the risk and reward is neither substantially transferred nor substantially retained, and the control test is also retained. The control test tells me that it is retained. So can I say this is the only permutation combination where a partial derecognition would apply? That when the cash flows have been transferred, or it's a case of PTA, the risk and reward is neither transferred nor substantially retained, and the control is being retained as well. So in this particular case, sorry, not control is retained, but we said the control, yes, is retained, then it's a case of a partial derecognition. Now this is going to be a slightly complicated accounting. So watch this carefully. I'm going to now take you to an illustration in the study mat and connect you with this. So I think let's have a look further now on the next illustration. You can see the third connect, continuing involvement in transferred assets. So if you remember, I gave you a case that maybe you assign your trade receivables and it's neither a case of a recourse nor a case of a non-recourse, but maybe that you're given a financial guarantee for a certain limited amount. So we cannot say the risk and reward is retained substantially. We cannot say the risk and reward is transferred substantially. It becomes a mixed case where it's neither. So you need to go to the control test in order to prove this. So I think let's have a look at illustration number 12. Now there are a continuous of 3 illustrations devoted to this concept. Illustration number 12A, illustration number 12B, and illustration number 12C. All 3 illustrations, what we're going to do collectively. We're going to do this collectively. So watch this carefully. It'll take me 5 minutes, but you'll get a good hang of the concept. So now listen very, very carefully. Let's have a look at illustration number 12A. Entity C agrees with a factoring company D to enter into a debt factoring arrangement. That means you've assigned your trade receivable, and since you've assigned your trade receivable, cash flows have been transferred. Under the terms of the arrangement, the factoring company D agrees to pay 91.5 crores less a service charge of 1.5 crores. So he agrees to pay you 90 crores in exchange for 100% cash flows. So we are very clear that it's a case of assignment of trade receivable. So it is a cash flow transfer. Now we need to see the risk and reward. We'll see. The receivables have got a face value of 100 crores and a carrying amount of 95 crores, which means the book value of the trade receivable is 95 crores. The company might have already created a provision for doubtful debts to the extent of 5 crores. The customers will be instructed to pay the amounts owed into the bank account of the factoring company. Entity C also writes a guarantee to the factoring company under which it will reimburse any credit losses up to 5 crores over and above the expected credit loss of 5 crores. Now, since the company has already created a provision for doubtful debts, so their book value of debtors is 95 crores. So they say that in any case, we have created a provisioning, and that provisioning is created with the help of what you call ECL model, expected credit loss model. So the entity C tells the factoring agency that I will bear a credit loss, that means a loss to the extent of 5 crores over and above that 5 crores which I've already provided for. So which means he is liable, but is his liability supposed to be unlimited? Or is his liability limited only to the extent of 5 crores over and above the bad debts which is already provided in the books? It's a limited amount. So can I say in this particular case, do you think the risk and reward is being substantially transferred? I don't think so. Do you think the risk and reward is being substantially retained? I don't think so. I think considering that it's a case of a guarantee where he's liable to pay only up to an amount of 5 crores, he has got certain involvement. But his involvement is not such that you can say that the risk and reward is either retained or the risk and reward is either substantially transferred. I think giving a guarantee would give us a mid situation. So we would say the risk and reward is being neither substantially transferred nor substantially retained. So you go to the control test. Now, in this particular case, I am not given any information wherein I can technically assess whether the control test is passed or not. But I would always consider that if it is a case of assigning trade receivable with a particular guarantee given to the factoring company, we would consider that the control is not transferred. The control is retained in this case, because you are liable to pay a certain guarantee. So we'll comfortably consider that you have retained the control. Then he adds on. He says the guarantee is estimated to have a fair value of 0.5 crores. Calculate the amount of continuing involvement asset. Right. I guess we've understood the question. That's more important. Now, what I'm going to do, I'm going to first of all take you directly to the illustration number 12C. Oh my God. I'm going to directly take you to the answer of 12C and then elaborate my points to you. Like in illustration 12B is asking for associated liability, I am directly taking you to the entry which is given in illustration number 12C. The illustration number 12C is saying that give me the entry in the books of accounts. Now have a look at this entry. And I'm going to give you something based on this. I'm going to split this entry into a total of 3 parts to make it very clear. As you can see, the entry is cash debit 90 crores. There is a loss on derecognition, which is 5 crores. There is a continuing involvement asset to the extent of 5.5 crores. Then there is a receivables, which is given a credit of 95 crores. And there is an associated liability, which is to the extent of 5.5 crores. Now, let me just come to the inputs in this particular case. Have a look at this very carefully. Well, I would advise that it would be more easy that if you split this entry into a total of 3 components, I would say it would be more easy that if you do the accounting for a partial derecognition in 3 parts, it'll become more easier in nature. Now look at this. When it is a case of a partial derecognition, at the first instance, you can derecognize the full asset, but we need to recognize another asset. So what we can do, you can first put the entry for a complete derecognition, bank account debit. You receive 90 crores from the bank on account of assigning your trade receivable, and your trade receivable is appearing in the books of accounts at 95 crores, and you get a balancing figure, which is 5 crores. And that 5 crores balancing figure is supposed to be a loss on derecognition. That is a balancing figure. So I think you can see one thing very clear, that what I have done, I have taken an entry almost, or I would say 100%, just like a case of a complete derecognition. If it would have been a case of a complete derecognition, I would have done the entry bank to financial asset and taken the balancing figure in the P&L account. That's one. Then I would say, let's go for the second entry, where you need to create a continuing involvement asset. I'm going to call it as CIA, a continuing involvement asset, and a corresponding associated liability. I'm going to call it as AL. Now you need to see that what is the level of involvement in that particular asset. Now the standard says that when you look at the continuing involvement, you need to consider the lower of the two. What is the value of the asset in the books of accounts? 95 crores. And what is your involvement? Your involvement is to the extent of the financial guarantee which you have given. You told the factoring agency that I will give you 5 crores of credit loss over and above that 5 crores which I've already provided in the books of accounts. So my involvement in the asset is to the extent of the value of the asset, which is 95 crores, or the financial guarantee which I've given, which is to the extent of 5 crores. So we will consider the lower of the two, and we will record an entry continuing involvement asset to associated liability. So you are retaining the asset to the extent of that 5 crores, and you are creating a corresponding associated liability as well. This is case of a partial derecognition. So which you can now see that in the first entry, you derecognize the asset completely, but then you have still recognized another asset by another name. So it's a case of partial derecognition. Because in the first instance, you derecognize the entire asset and then you create another asset with a different nomenclature. So it becomes a case of a partial derecognition. I guess I'm pretty clear on this. So the first entry looks like and is exactly a case of a complete derecognition. The second entry is, recording the continuing involvement asset and the corresponding associated liability. And then there is a financial guarantee which is given. Since there is a financial guarantee which is given, in this particular case, the financial guarantee can also be recorded with a separate entry, and you can put another entry containing involvement asset and associated liability, gives a credit, and the fair value of that financial guarantee is given 0.5. Because when you record the financial guarantee in the books of accounts, the initial recognition is always done at a fair value. Wow. Now, if you club all these three entries, you're going to see the resultant entry, which is given in the study material. But I think this makes life more simple, I guess. Now, you can see the entry is cash 90, loss on derecognition is 5, containing involvement asset is 5.5, which is 5 plus the fair value of the guarantee 0.5. Receivables is given a credit to the extent of 95, and the associated liability is taken. And then there is a note which says that the guarantee liability of 0.5 crores shall be amortized to the P&L over the underlying period. Now, they've not given us, so I'm not getting into that details. Otherwise, I think even, a little lesser number of hours would also be less. One could get on to a PhD levels on financial instruments, but we're not intending to do that. Okay, so I think let me just club up this information once again. And of course, you said factor can sell the financial asset in the market, so control is transferred. Okay, let me put this once again to you. As I said, it's my presumption. Since I am not given any facts in the question, it's my presumption as well that the control in this particular case is retained. So in any case, if you get a question where the question is silent on this, we're going to comfortably consider that the control is not transferred to the factoring agency. So we will comfortably assume that the control is retained. Now, let me put this accounting, and then we are almost done with the concept of derecognition of financial assets. So as I said, if it is a case of a continuing involvement, that is a case of a partial derecognition. A case of a partial derecognition means that it's a case of a continuing involvement. So in this particular case, what you do three separate entries to my suggestion. You first of all derecognize the entire financial assets from the books of accounts and put the entry, what you do for a partial full derecognition. Bank is given a debit for the consideration, the financial asset is given a complete credit, and the balancing figure is taken to the P&L. Then you put an entry to the extent of your involvement, which is the lower of the two, the value of the financial asset or the guarantee which you have given, whichever is less. Create a contra entry in the form of a continuing involvement and associated liability. And then you also need to record the financial guarantee, record it separately. Now, I think this is the right time to tell you something which I gave you in the last class as well. And I think now you can appreciate this very well. If you look at the concept of a derecognition from a balance sheet perspective, if you look at the accounting of a derecognition from a balance sheet perspective, I think now I'm going to make complete sense. And you can see the beauty of accounting in three combinations. When it is a case of a full derecognition, when it is a case of a no derecognition, and when it is a case of a partial derecognition, look at the impact of the debt in the company. So in the first case, when it is a case of a full derecognition, what is happening? There was a financial asset in the books of accounts. It gets completely derecognized, and in its place, you get the bank figure. Well, of course, any profit or loss is taken to the P&L. So it's a replacement of a more liquid asset in the balance sheet. Mind the words carefully. A full derecognition allows me that I don't have any debt burden on the company. The company, which has got a huge pool of financial assets, is being able to create a huge liquidity without creating any debt burden. Why should the company be asked to borrow debts if it needs finance? It can go in for pooling of financial assets, approach a factoring agency, and meet the derecognition principles and get a wonderful accounting at the same time. So the full derecognition allows the company to get a good level of liquidity without creating any debt burdens on the company. Beautiful. Now, when you're not eligible for a derecognition, then that means you were trying to achieve liquidity, but you wanted to perhaps, not create a debt. But we said, boss, if you're not going to fulfill the derecognition principle, your financial asset will continue. Because if you're not eligible to derecognize, you are indirectly taking a loan. Because if you're not eligible for a derecognition, you are indirectly taking a loan. So your accounting creates a financial liability and a bank balance correspondingly. So it creates a complete debt burden on the company. So when a no derecognition is allowed, we are indirectly telling the company that you want to enter into an arrangement, which is indirectly not a case where you can derecognize. So let's tell you that since you're not eligible for a derecognition, you are indirectly, in substance, taken a loan. By entering into different kind of transactions, you're trying to just bypass the requirements and you've indirectly, boss, taken a loan. So you need to create a debt in the company. So you've created a liquidity in the company at the cost of creating a debt. So there are two extreme accounting. A full derecognition means no debt burden on the company. Liquidity without creating a debt. And no derecognition would mean liquidity created at the cost of a complete debt burden on the company. And then partial derecognition is a blend in between. You got a financial asset in the books of accounts, and this financial asset gets eliminated and the bank takes in its place exactly what we did in the first case. But then it is now a case of a full derecognition. So you create a continuing involvement asset, but which is a very nominal figure. Like, for example, against 95 crores, you are creating a continuing involvement of just 5 crores and a corresponding associated liability. So it creates a debt burden only to the extent of a small amount. So partial derecognition is at least much better as compared to no derecognition. The company has created a, you can say, liquidity position, but at the cost of creating just a very nominal amount of debt burden on the company. So now you can see the three different kinds of accounting, and I think you can definitely see that depending upon the parameters met, we have suggested three different kinds of accounting for a derecognition. It's a beautiful area of accounting, and I think a very interesting perspective, especially if a company were to carry on a ratio analysis after the derecognition. You would see that a full derecognition doesn't, make my debt equity ratio anyway bad. A complete no derecognition would, change over the debt equity profile of the company. And a partial derecognition is a midway approach. So it'll have a little effect on the debt equity ratio of the company, but not a very adverse effect at the same time. Right. I guess I made complete sense, friends, on that. Okay. I think, Shobham, you said, so can you explain the logic of adding the guarantee value with the fair value of the guarantee? Well, in this particular case, if we look at the financial guarantee, it is supposed to be a financial liability. It is supposed to be a financial liability. And since it's a financial liability, you need to recognize it in the books of accounts at 0 point of time at a fair value. Now, once we record that financial guarantee at a fair value at 0 point of time, so this entry is the recognition of that financial guarantee. Because whenever we give a financial guarantee and it is supposed to be recognized in the books of accounts, then, you can even say that instead of calling this as an associated liability, let's say you give it a nomenclature financial guarantee. I mean, that is for understanding point of view. Because your associated liability is to the extent of two components. One is the amount which you're liable to pay if something goes bad. The factoring agency can catch you for that. And your liability is also to the extent of the guarantee. So I would say that in case that associated liability word is bothering in the third entry, one can also comfortably call it as a financial guarantee. But at the end of the day, it's going to be clubbed up with the associated liability. So whether you call it as associated liability or a financial guarantee, one and the same thing, right? So this is one bit. Now, I can, of course, tell you one thing. Clarities of thoughts would definitely increase further if one were to get into more details in terms of the subsequent accounting of the CIA and the subsequent accounting of AL. I am not going to get into all that. Because that can become a very complicated affair. Even in the study material, they've not get into that kind of mode. So I'll not take you into that mode of researching further that what the accounting is going to follow on a subsequent level. I'm pretty sure the education material on financial instruments has been in a pipeline for some time. I'm very eagerly awaiting for the education material to come on financial instruments. And I think once it comes, I think it will be a treat to watch it. And I'm pretty sure that there will be a lot of inputs in that education material. So at least next time, when I'm covering financial instruments, hopefully, I would be, incorporating the aspects of the education material also in the discussions. Okay. So, right, I think got it done. Wonderful. Right, so this completes one part of the derecognition of financial assets, but I'm not done. My derecognition of financial assets is not done. I've taken only two aspects. One is in terms of derecognition parameters, and one is in terms of accounting. I feel, looking at your answers, I think if I ask you at this stage that what is your comfort zone on the derecognition of financial assets, I think it should be pretty good. That's what I feel. What's your inputs on that? To my understanding, I think your comfort zone should be very good. You must have, enjoyed the parameters of derecognition and the accounting which is related to the parameters. And I think you would have got a good clarity in terms of the parameters and the accounting linkage as well. Okay, so do let me know on this. Now, I think let's take you to the third aspect of our discussion. And Sham, sir, there is no coverage of that in a syllabus, not in the study material, not ever come in the exams as well. So I think keeping that considerations, I'm restricting myself because we've got almost like 9 classes on financial instruments. And today is the 8th class. We've got one more class and we've got still some issues pending, but not, I think we'll still manage easily in terms of the next class. Because we've got one area on embedded derivatives, one is on impairment and hedging, but we need to just give you a very basic overview in terms of impairment, hedgings, and other things. Not a very complicated kind of accounting, though, trust me, in a practical life situations, things can become very, very complicated in terms of financial instruments. A very technically course standard. Trust me, one could convert financial instruments as an entire subject as well. You heard me correct. One could convert this into an entire subject as well, but we don't want to get into that mode, right? Okay, so far so good. And yes, I think, Shomi, you said, sir, it is good getting the concepts clear. Yes, Manini. And Kaushiki, sir, can we do one more question on the partial derecognition? Well, I think there is no more questions available on this area. Neither any examination or RTP questions. This is the only question which is available on a partial derecognition. Okay, so now let's take it further. If you remember, when I started my discussion on derecognition of financial assets, I gave you that there are, number one, parameters to decide whether we go in for a complete derecognition or no derecognition or a partial derecognition. We have covered those parameters. The second is we covered the accounting. And now we are going to come to another third area of discussion, which is given in the study material. That do we derecognize a part of the financial asset or do we derecognize the full financial asset? Now you would say, what do you mean by this? Let me, I think, explain now. Well, just imagine if you're looking at, for example, a loan receivable in the books of accounts. Hear this very carefully. It's a very simple concept. Now, imagine that you are given a loan receivable in the books of accounts. So it is a financial asset to me. Can I say this loan is being recognized at a fair value in the books of accounts? And what is that fair value? Is it the fair value is supposed to be the present value of the principal and the interest component, right? So when you consider the financial asset in the books of accounts, initially it is recorded at a fair value. And what is the fair value of the asset. It is the present value of the principal and the present value of the interest. So we can say the loan which appears in the balance sheet of the company has got two components. One is the principal component and one is the interest component. Now, when you go in for, let us say, a transfer of the cash flows to another party, you could tell the party that, okay, I will only give you the right to the principal flows, not to the interest. Or you tell the other party that I will give you the rights in terms of interest, but not the principal. Or maybe you agree to transfer both of them. You tell the other party that, okay, I'll give you transfer the cash flows from the principal and the interest element both. So the entity may take a conscious call that when they go in for, let's say, assigning its trade receivable. Till now, what we have seen that you've assigned your trade receivables in entirety. But then there is also a possibility that the company assigns its trade receivable and it enters into the arrangement where you transfer only the principal element, or you transfer only the interest element, or you transfer both the principal and the interest element. Well, in the study material also, they have not gone into the accounting of this aspect. So let me caution, as we go to study this particular section, what will start coming to your mind is, sir, how are we going to do the accounting of this particular aspect? We are not covering the accounting of this aspect. The accounting we have covered is a case where the company enters into an arrangement where the entire financial asset flows are transferred. So we are not going to come to the accounting when you transfer only a principal flow or an interest flow. The illustrations given in the study material is only concentrated towards the fact that you need to tell the examiner that, okay, in this case, do we derecognize the entire asset or do we derecognize only a component of the asset, that is, you can say, a part of the financial asset. So what I'm going to do, I'm now going to give you the parameters which are given in Index 109, which tells me that in which particular cases a derecognition of a part of the asset can take place. When can you say that, okay, let me derecognize not the entire asset, but let me derecognize only a component of that asset? So there are certain parameters which are given in the study material as well. And this is also there in Index 109 text. So let me just come to the initial illustrations, because from illustration number 7 onwards, we were looking at, I think rather 6th, we started with PTA. So before that, I told you illustration number 4 and 5 were on this aspect. Yes, now let's come to the illustration number 4 and 5. So this illustration 4 and 5 is devoted to the concept of identifying whether a derecognition of a component of the asset or part of the asset can take place or not. Now, hear me very carefully. This is slightly tricky, and you might tend to get confused on this. So just hear me very carefully as I read. Now, there are 3 cases which you can see on the screen in the study material on unit number 5. And I think, let me tell you the page number as well, 12.149. Now, there are 3 cases where it says derecognition requirements are applied to a part of the financial asset if that part meets any one of the 3 conditions. In these 3 cases, a part will be derecognized. Other than these 3, it's always a case of a full derecognition. So we are now looking at the fact that when do you say that I will derecognize a component of the financial asset? Other than these 3 cases, in all the cases, the complete asset, the entire asset needs to be derecognized. Now, it says the language is slightly technical, but I will give you a crux very shortly. It says the part comprises only specifically identified cash flow. It says the part comprises of specifically identified cash flow. For example, when an entity enters into an interest rate strip, as I said, that you enter into an arrangement where you transfer only the principal portion, it's called the principal strip. Or you transfer only the interest portion, that is called an interest rate strip. So when the company enters into an assignment of trade receivable, tells the factoring agency that I am going to transfer only principal. We say that you have transferred the principal strip. I'm going to transfer only the interest. It is called the interest strip. The clause A says that you are transferring either principal or you are transferring either interest. But in this particular case, we are transferring 100% principal or 100% interest. So it says specifically identified cash flow. So for example, when an entity enters into an interest rate strip, whereby the counterparty obtains the right to the interest cash flow, but not the principal cash flows from a debt instrument, derecognition principles applied only to the interest cash flow. So you transfer one of the cash flow, principal or interest, but you transfer it completely. Now, I think let's look at the clause number B. The part comprises only a fully proportionate share of the cash flows. The language is very interesting. Fully proportionate share of the cash flows. For example, when an entity enters into an arrangement where the counterparty obtains 90% of all the cash flows, that means principal as well as the interest, but it is 90%. That means it is equal percentage. So if the principal and the interest cash flow is transferred, you need to transfer both of them to the extent of equal percentages. And then it says in clause C, the part comprises fully proportionate share of specifically identified cash flow. For example, when an entity enters into an arrangement where the counterparty obtains 90% of the interest, derecognition is applied to 90% of the interest. Sir, we did not understand it much. Sir, we did not understand it much. I can understand. Let's make your life simple now. Now, hear this very carefully, what I'm about to give you, and you'll get the entire concept. Hear this very, very carefully. Now, you would have appreciated one thing, I guess, pretty for sure. A company, when it says that it has got a financial asset, there are definitely two components of the financial asset, principal and interest. Now, watch this carefully. Next 3 minutes, you will get the entire concept. So the financial asset has got two components, the principal component of the cash flow, the interest component of the cash flow. So now what are the various permutation combination? When you transfer the cash flow, you tell the person, I give you principal only. I give you interest only. I'm putting in between or. I tell the person, I'll give you only principal. I will give you only interest. And you decide in these two cases that I give you 100% principal, but no interest, or I give you 100% interest, but no principal. So you give either of them and you give them fully. Second, you only give one of them, but less than 100. But less than 100. It's less than 100. Can I say this is one set of combination? You transfer the principal only fully. You transfer the interest only fully, or you transfer principal less than 100, or you transfer interest less than 100. I guess the chain is clear. Look at this combination very carefully. You transfer one of the two. What is important is you transfer one of the two. I think I'm highlighting this again. So you transfer any one. And you transfer it 100 or you transfer less than 100. So there are basically 4 permutation combinations arising in this. I transfer the full principal with no interest. I transfer the full interest with no principal. I transfer the principal 80%, no interest. I transfer the interest 80%, no principal. I guess I'm clear with the combination, right? So you've got one situation where you tell the other party, counterparty, boss, I give you principal only, fully. Boss, I give you interest only, fully. Boss, I give you interest 80% only, no principal. Boss, I give you 80% principal, but no interest. This is one set of combination. Now let's look at the other set of combination as well. Now in the other set of combination, I tell the person, I'll give you principal and interest both. So in this case, we are saying we'll give you both. We said we'll give you the cash flows or the principal and interest both. So they may be given 100%, both of them, or they may be given equal percentage, both of them, or they may be given unequal percentage, both of them. I don't think so there are any other combinations following. These are the only three combinations, right? You tell the person, I'll give you the principal and interest fully. You tell the person, I'm going to give you the principal interest 80-80, or I'm going to give you principal 90 and interest 80%. Am I clear, friends, till this stage? Am I 100% clear on the combinations that your deal with a counterparty could be in terms of giving a principal only, interest only, fully, or principal less than 100 or interest less than 100, or you transfer both the principal and interest fully, or you transfer principal interest equal 80-80 or unequal 90-80. These are the only permutation combinations. Wonderful. Now, I think let's come back to the study material and see what it says in clause ABC. It says the part comprises of specifically identified cash flow. For example, when you transfer the interest rate step, but not the principal step. That means if I were to correlate, is this covered in clause number A? Yes. The clause number A say you transfer the principal only, fully. You transfer the interest only, fully. Clause A is covering this. Now let's have a look further in terms of the next one, the clause C first. The part comprises of proportionate share of specific cash flow. You transfer 90% interest only. So can I say this is also getting covered in clause C? If you transfer one of the components fully or one of the components partially, you can derecognize a portion of the asset. You can derecognize a part of the financial asset. In these cases, you will be able to derecognize a part of the asset. Now, let's go to the next one. Now, if you transfer the principal and interest fully, that means it's a case of a full derecognition. The entire asset needs to be derecognized in this case because you have transferred the entire asset itself. You're not transferring a component. You're transferring the full component, principal and interest combined. Now let's have a look at the clause number B in this case. It says the part comprises of fully proportionate cash flow. You transfer 90% of all the cash flow. So that means it is equal percentage. If it is equal percentage, it gets covered in clause B. You can derecognize a part of the asset. ABC is the exhaustive list. If you go in for unequal, then also you have to derecognize the entire asset only. I think now I can tell you one thing. If you transfer just principal 100 or less than 100, you can derecognize a part. If you transfer the interest 100 or less, you can derecognize a part. So you transfer any one component 100%, less than 100, part can be derecognized. Number two, if you transfer the entire principal interest, in that case, full derecognition. You transfer equal percentages, you can derecognize part of the asset. But if you transfer unequal percentages of principal and interest, then you again need to derecognize entire assets only. Got the picture? So moral of the story is you might be asked in a particular question that you need to decide, do we derecognize a part or do we derecognize the entire asset? But I'm not getting into the accounting of this area. Because in the study, we've been given only a situation where the cash flows are being fully transferred to the other party. We're not covering this area of accounting as such. Okay, but I guess I am pretty clear on this particular part, I guess. Okay, let's now do one thing. Let's take up illustration number 4 and decide. So we can see illustration number 4 and decide that derecognition will be applied to the part or derecognition will be applied to both. So remember, if you transfer one of the two, fully or partially, part. If you transfer both of them equal percentages, part. If you transfer both of them unequal percentage, full. Okay, let's look at the illustration 4. whether derecognition principles will be applied or not. Interest strip of the interest-bearing financial asset, the part entitles the holder to interest cash flows only. Can we derecognize a part of the asset? Yes. You've transferred only the interest portion, one component, whether it is full or partial, doesn't make a difference. The dividend strip of an equity share, that is a part entitles the holder to only dividends. Yes. For a debt instrument, you transfer the interest flow. For an equity instrument, you transferred the dividends flow. It's a case of part derecognition. Then he says cash flows up to a certain tenure. Now, let me tell you, the list of clauses which I give you is an exhaustive list. So if you put any ifs and buts in between, the case, it would be a full derecognition. If you put any full ifs and buts to it, that I will transfer only first 5 years, last 5 years, any ifs and buts would make it that you need to go in for a complete derecognition. The cash flows, principal and the asset, rather it should be interest, up to a certain tenure or the first right on the cash flows. Say the party gets the holder 80% cash flows for the first 4 years out of the 6-year tenure. Now, you need to go in for a complete derecognition in this case. So what is important is that if you transfer the full cash flows, principal and interest, it has to be complete transfer without any ifs and buts in that case. If there are any ifs and buts, the derecognition has to be for the entire asset and not for the part of the asset. Right, so a similar kind of illustration is given in terms of illustration 5 as well. I think you can do that as well. Let me do the first part, you can do the second one. Entity Y transfers the right to the first or the last 90%. You decide. It says first or the last, no ifs and buts. The moment you apply ifs and buts, a part cannot be derecognized. It has to be a complete derecognition in this case. Then he says in second part that you transfer 90% but provides a guarantee. So the moment there are ifs and buts, whether it is in the form of guarantees or moment it is first or last or first initial years, whatever, it cannot be a case of part derecognition. Right, so I think this takes care of my third part. I know this may not be, very clear because we are not doing the accounting for this part, but I've just told you to the extent, it's covered in the study mat. So that at least if you get a question on that area, in which cases a part is eligible for derecognition and in which case you need to go in for a complete derecognition. This completes my first phase of discussion on a derecognition of financial assets. Now I am going to take you to the next area, and that is derecognition of financial liability. Now this is pretty easy, not a very technical area as far as a derecognition is concerned. So let's now concentrate on the concept of derecognition of financial liability. Well, just the way we said, a derecognition of financial asset means removal of the asset from the balance sheet. A derecognition of financial liability would also mean that there is a removal of financial liability from the books of accounts. You derecognize the financial liability from the balance sheet of the company. So I think I can very well say that if you derecognize a financial liability, the entry is financial liability debit at a book value, and the bank will be given a credit, and that would be equal to the consideration paid, and any balancing figure in this entry is going to be taken to the profit and loss account. Because in any case, there is no concept of OCI in terms of financial liability. So the moment you settle a financial liability on a full and final settlement, I paid the dues to the other party, and it's a case of full and final settlement. So the entry will be financial liability debit at a book value, and the bank is given a credit to the extent of the consideration paid. So whatever is the balancing figure, gain or loss, is going to be taken to the P&L, as simple as that. So you're not going to get any question on this area when there is a complete derecognition of a liability. Now, the area what we need to cover from the examination point of view, extensively covered in the study material as well, is the area what we call SDR. Is the area which is called SDR, very relevant from a practical point of view as well, and even from the examination perspective. Now, let me explain. The concept of SDR is called a strategic debt restructure. SDR is called strategic debt restructuring. So when we're looking at SDR, it is called a strategic debt restructuring. Now let me explain what is this strategic debt restructuring all about. We know that many times companies takes loan from banking companies. So you will see this very extensively happening in a practical life, that a company has taken loans from the bank, but it's not in a liquidity position to pay interest to the bank, and it's not in a position to pay the principal to the bank. And it does not mean that they don't have intentions to pay. It's not always like that if you're unable to pay the money to the bankers, that you're not paying them interest on timely basis, or you're not making principal payments, but you have all the intentions to pay. The bank also understands that position, that your inability to pay doesn't mean that your intentions are bad. So they would enter into negotiations with you, and they would give you more relaxations in terms of your existing arrangements. The banking company would tell you that, okay, we have a certain original negotiated terms and conditions, but let's renegotiate and let's restructure the debt. So a debt restructuring is a very vital element in terms of a practical scenario. That you approach the banking company and tell them that your inability to pay is temporary in nature, and please accommodate me, because my inability doesn't mean a bad intention to pay. So the banks would agree to a restructuring of the debt. Now, this restructuring of the debt would also lead to an accounting changes in my books of accounts. So when you renegotiate for a debt, in this particular case, a renegotiation of the debt could lead to two kinds of accounting. One is what we call an extinguishment accounting, and one is what we call a modification accounting. Now, what we need to do in this particular case is that when you go in for renegotiations with the bank, there is a test, what we call a 10% test, which is conducted in order to decide how the accounting for that renegotiations, restructuring is to be done. We conduct what we call a 10% test. Now, let's see how this 10% test is conducted. Now, this 10% test is conducted in a very simple three-step model. I've converted this into a very simple three-step model, that how do you conduct to decide that we need to apply an extinguishment, or do we need to apply a modification accounting. Step number one, what we're going to do, we're going to calculate the present value of the remaining cash flows. I have an existing loan with a bank, so I will calculate the present value of all the remaining cash flow. So whatever is my remaining cash flows, I will see that as per the original terms with the banking company, what is my cash flows, the remaining cash flows, when I entered into renegotiations with the bank. So take the present value of all the remaining cash flows based on original terms. And to calculate the present value, we will consider the original EIR itself. So what I'll do, I will say, okay, that on the date of renegotiations, let me see what is the remaining cash flows. And the remaining cash flows based on original terms will be taken, discounted on the basis of original EIR. Then what we'll do, we'll again, in the step number 2, calculate the present value of the new cash flows. You've renegotiated with the bank, and if you've renegotiated with the bank, so we would have the new terms with us. We'll have the new terms with us. So we will say, okay, let me get the entire cash flows based on the new terms. So I'll consider the new terms and calculate my cash flow. And in this new cash flows, I'll also add any transaction cost which I might be incurring. So I will consider all the cash flows based on the new terms and take a present value. And this present value again will be taken at the original EIR itself. So there will be no difference in terms of the discounting rate to be used to maintain a parity. So basically what you're doing, you're arranging the cash flows based on original terms. You're arranging the cash flow based on the new terms, and you're looking at the variations in the cash flow. So in the step number 3, what we're going to do, we're going to take the difference between the step number 2 and 1 and express this difference as a percentage. So you can take the difference between 2 and 1 and express it as a percentage of 1. So basically you want to look at the variations in the cash flows which have occurred due to renegotiations. So when you entered into the original term, you say, okay, this is the remaining cash flow based on the original terms. This is the cash flow based on the new terms. Let's see what is the variations in the cash flow. So the variations in the cash flows will be expressed as a percentage. Now, depending upon this percentage, you could get two inputs in the percentage. Either the variation is 10% or maybe more than 10%, or the variation is supposed to be less than 10%. So the variation could be either 10% or more, or the variations could be less than 10%. If the variation is 10% or more, the standard says we need to apply the concept of what we call extinguishment accounting. We need to apply the concept of what we call extinguishment accounting. The word extinguishment means that you extinguish, you remove the financial liability from the books of accounts. So that means if the variation is 10% or more, it indicates a material change. That 10% test can also be called as a materiality test, where you're evaluating that since the modified terms have resulted in variations in terms of more than 10%, you need to go in for an extinguishment accounting. But if the percentage variation is less than 10%, it indicates it's not a very material change. And if it is not a material change, then we don't remove the financial liability from the books of accounts, and the standard gives us an input, what is called a modification accounting. In which case, there will be no removal of the financial liability from the books of accounts, but we would be just modifying the existing liability itself. So what you need to see in a particular question, that if you go in for a negotiations with the bank, if you go in for a negotiations with the bank, what we call a debt restructuring, you need to first of all choose and decide that are we applying an extinguishment accounting or are we applying a modification accounting. So you need to apply a 10% test. What I say is a materiality test. You need to, at the first instance, apply a 3-step model. You need to first of all consider that, okay, let me calculate the remaining cash flows present value based on original terms. Let me calculate the new cash flows based on the new terms, use a common discounting rate, original EIR itself, and then express the difference between step 2 and step 1 as a percentage. So basically the intention is to look at the changes in terms of the materiality levels of the cash flow. So if the percentage variations in the cash flow is more than 10%, the standard says we need to go in for an extinguishment accounting. Remove the existing liability from the books of accounts and recognize a new liability in its place. And if the results are less than 10%, we are supposed to use a modification accounting, which does not mean removing the financial liability from the books of accounts, but there will be some adjustments which will be done. Now, the question rises that if you come to extinguishment accounting, what do you do? If you go in for a modification accounting, what do you do? I think that I'll explain directly with an illustration. So what I'll do, I'll take 2 illustrations with you. So one illustration will elaborate that you passed the 10% test and you're going to see the extinguishment accounting. And another case I'm going to give you where we're going to fail that 10% test and we're going to see the modification accounting applicable in that case. Okay, Vinay, you said, so please share us the accounting glimpse just a little. Okay, you mean to say the accounting glimpse of what? You mean to say the glimpse in terms of the subsidy accounting for CIA, etc., outside the purview at the moment? We don't want to get into all that at this stage. As I said, the subject on financial instruments is very, very, very deep indeed. And trust me, if you start getting into the complicated accounting, I think even 80 hours would be very less inefficient in terms of covering financial instruments. Right now you're learning at a very basic level of stage. Trust me, when you go in a practical life arena, you're going to learn a lot of things. The world is open to you in terms of learning a lot of things in a practical life. When you go to see things and apply them in practical life, as a practitioner, I also do that. And when I see things in a practical life, it's a new learning each day. Trust me, it's a new learning each day. Okay, so I think let me now come back to the study material and take you on the derecognition of financial liability elements to you. So we are now coming to the financial liability derecognition. So this is the area starting from page 12.161. So let me take you to the example number 3. There is an example number 3 which is given in the study material on page 12.164. So let's have a read. There are a lot of computations to be done in this particular example, but I think I'll avoid doing too many calculations because otherwise, we'll spend a lot of time doing the accounting. So I'll pick up the few calculations wherever it is convenient and easy to pick. Let's now read. It says on 1st January 2000 X0, XYZ issues a 10-year bond for 10 lakh, which is bearing interest at the rate of 10%, and it's payable annually on December each year. The bonds are redeemable on December X9 for 10 lakh. So we are very clearly given that we issued a bond for a period of 10 years. The interest rate is 10%. And he says no cost or fees is incurred, no TC, no processing fee. I like it. Can I say if there is no TC and if there is no processing fee, no adjustments are required initially. So he says the effective rate is therefore 10%. We're very safe. Let me, ask you something. Can I say since the contracted rate is 10% and the effective interest rate is also 10%, it is very clear that this transaction is at market term. The transaction value and the fair value seems to be 10 lakh rupee. And I think there is no concept of any TC, no concept of any processing fee, which is not triggering the need to calculate any kind of new EIR as well. I hope I am made complete sense on that. Right? I guess I made complete sense on what I said, that the contracted rate is 10%, the effective rate is 10%, it's an at market transaction. And in this particular case, we can also say with no TC and no processing fee, the transaction value and the fair value is also same. Then he says on 1st January X5, which is 5 years later, the bondholders agree to a modification. So they might have entered into a renegotiations with the holders, and the term is now extended to 20Y1. Earlier, the maturity date was December X9, and now it is 20Y1. Interest payments reduced from 10% to 5%, and the redemption will now take place on December Y1 at 15 lakhs. And there is a legal and other fees which is incurred. So there is a TC which is being incurred at the time of renegotiations. And XYZ determines that the market rate of interest on a similar borrowings is 11%. So on the date of modification, if you were to consider a new EIR, a new market rate of interest, it is given 11%. Now, I think first of all, what we need to decide in this case is that is this a case of a modification or is this a case of extinguishment accounting? So at the first instance, we need to apply a 3-step model. So I think let's decide that. So let me, first apply my 3-step model. We are looking at example number 3. This is on the unit number 5, and this is page number 12.164. So page number 12.164 of the study material, unit number 5. Okay, let's begin the journey. We're looking at step number 1, step number 2, and step number 3. Can I say in step number 1, you need to consider the present value based on original terms. We need to consider whatever is the remaining cash flow. So we need to consider that based on the remaining cash flow, what is the present value? Now, let me ask you something. Can I say sitting on January X5, I made a renegotiation on January X5. If I were to consider the present value of the remaining cash flows discounted at 10% original EIR, I think it should come to 10 lakh itself. Agreed? If I were to consider my discounting at the rate of 10% for the remaining cash flow, the present value will be equal to 10 lakhs for sure. The reason is simple. The contracted rate is 10%, and you're going to discount it at 10% itself. So the compounding is at 10, the discounting is at 10. So even if you try to calculate that there is remaining cash flow, which is supposed to be 1 lakh rupees to be paid for the next 5 years, and there is another 10 lakh rupees to be paid at the end of 10th year, I think even if you calculate this, the present value of all these cash outflows at 10% discounting rate, 100% will come 10 lakh. So even if you feel that you tend to get confused in the exams, you can make your calculations. You can say for the next 5 years, the cash flows are 1 lakh rupees each. And at the end of the 10th year, you're going to pay, that is at the end of another 5th year, I would say. At the end of another 5th year, you're going to pay another 10 lakh rupee. So the present value will come to 10 lakh rupees itself. Then we go to the next step and we say that, okay, let's now consider the new terms. Let's now consider the new terms and calculate the present value based on 10% factor itself. Now, in this particular case, the new terms tells me that there has been an extension. Now, the period of the maturity extended to December Y1. So that means it's got extended from X9. So you can say after X9 will be Y0 and after Y0 will be Y1. It's got extended by another 2 years. And the interest payment instead of 10% is come down to 5%. Okay, so before that, let me also add something. In this particular case, in second step, we also need to take care of the TC as well. But I think let's first take care of the principal and the interest. So the interest payment is going to be 5%. So you are going to pay now 50,000. And this is going to be paid for the next 7 years. Because the maturity date has been extended to December Y1. So it's got extended by another 2 years. And you're going to pay 15 lakhs at the end of the 7th year. So we need a PV factor for the 7th year end as well. And to this, we'll also include the TC. The TC, the legal fees incurred is to the extent of 1 lakh rupees, which is paid at time 0. So the P factor is 1. So we need to consider all the cash outflows, and these cash outflows are based on the new terms. So let me get the discounting factor at 10% 7 years. So 10%, 1, 2, 3, 4, 5, 6, 7. The 7th year factor is 0.513. And the cumulative total I think, let me pick this figure from the solution itself. Calculating would take a little time. So I think the cumulative total of this, I don't think so we given. So I think I'll have to compute this. So let me take 10% 7 years total. 1 divided by 1.1, twice, thrice, 4, 5, 6, 7. 4.868. So based on the new terms, we're going to pay interest of 50,000 for the next 7 years. We're going to pay 15 lakhs at the end of the 7th year, and 1 lakh rupee TC will be paid at time 0. So 50,000 into 4.868, 243,400. So I think this total is working out, I guess, equal to 11,13,300. I think is the total. I think that is correct. So we got this, yes, 4.868. That's right, Shubham. So 11,13,300 is the total. Now, if you look at the variation in terms of percentage, in step number 1, we got a figure of 10 lakh. In step number 2, we got a figure of 11,13,300. So if you look at the variation is 1,13,300 over the base of 10 lakhs, which is step number 1. And if you look at the percentage of variation, the percentage of variation is coming to 11.33%. So if you look at from the materiality test point of view, there has been an 11.33% variation. And if it is an 11.33% variation, that means it's more than 10%. So being more than 10%, we would now apply the case of extinguishment accounting. We would apply the case of what we can say extinguishment accounting. So I think this is the 3-step only for the purpose of deciding whether we are applying an extinguishment or whether we are applying a modification accounting. Now, once we've decided that an extinguishment accounting would apply, now let's see what is the journal entry which we're going to do at this stage. You need to derecognize the existing financial liability at a book value. So debit 10 lakh rupees. You're going to recognize a new financial liability. So give a credit to the financial liability. But this credit, remember, is got to be given at a fair value. Because when you recognize any financial liability or financial asset initially, it is always recorded at a fair value. So in this particular case, we need to record at a fair value. And now remember, please don't look at the second step. People will generally get a tendency that in terms of deciding the 10% test, I've done some calculations in step 2. That is not the fair value. Because in step number 2, you've applied the original EIR. The fair value is going to be computed based on the new effective interest rate, which is 11%. On the date of modification, we're very clearly given in the question that the market rate of interest on a similar terms is 11%. So we need to consider the fair value based on the new terms using the new EIR itself. So we can now consider that we're going to pay 50,000. And let's take a 7-year factor at 11%, and you're going to pay that 15 lakh rupees at the end of the 7th year. But don't take any TC. The TC was taken for the materiality test, but it's not going to be reduced from the financial liability. Once we understand that there is an extinguishment accounting, you will not be able to spread that TC by adjusting the financial liability. Once you are applying an extinguishment accounting, the TC will be separately charged to the P&L immediately. So the TC is adjusted to the fair value only when you initially recognize the financial liability. At the time of debt restructuring, if we conclude that this is a case of extinguishment accounting, you are not allowed to make any adjustments of TC against a financial liability. The TC is going to be separately, immediately expensed to the P&L. You cannot be given an advantage, after you've been, restructuring your debts to the bank. The bankers, in this particular case, even the accounting doesn't become favorable. So TC will not get adjusted to the fair value at the time of restructuring. So let's consider at 11%, 1, 2, 3, 4, 5, 6, and 7. So I think the factor at the end of 7th year is 0.482, and the cumulative factor is 3.811. So we are taking the present value of the new cash flows using the new effective interest rate. So 15 lakhs into 0.482, 723. So this is, I think, coming to 913,550 if I guess my calculations are correct. So the new financial liability is coming to a total of 913. I think that seems to be pretty correct, I guess. No, I think this is not correct. Maybe I have some calculation errors on 11%. I think it's coming to a total of 958,097. I think this is coming to 958. This is coming to 958,097. So maybe some calculation errors, but you can get the fair value. So 50,000 will be discounted for the next 7 years. I think the factor was 4.712. So this is 4.712. So 50,000 is going to be paid for the next 7 years. And 15 lakh is going to be paid at the end of the 7th year. So this figure comes to 958,097. So now whatever is the balancing figure in this particular case is a gain arising on extinguishment accounting. So this will be taken in the profit and loss account. So whatever is the balancing figure in this case, that is 10 lakh rupee minus 958,097. So we get the balancing figure 41903. This is the gain which is arising on the extinguishment accounting. But apart from this, you also need to put another entry, profit and loss account debit, and bank will be given a credit for the TC. So 1 lakh rupees TC has been incurred. So you need to also immediately expense the transaction cost as well. Now, if you look at the study material, 1 lakh rupees is the TC debited in the P&L, and 41,903 is the gain. So if you look at the net position in the study material, they've given the net figure as well. And that's given in the end. The gain or loss is given at 58097. That 58097 is a net figure, which is 1 lakh rupees of TC, which has been debited to the P&L, and the gain which arose at the time of the extinguishment accounting, which is to the extent of 41903. So that's how they've taken the net position, which is 58 whatever. Right. So the moral of the story in terms of the extinguishment accounting is that once you meet the 10% test and you say that, yes, it's time to remove the financial liability from the books of accounts, you need to give a debit to the financial liability, which is to the extent of the book value. And you need to give a credit to the financial liability. But remember, when you give a credit to the financial liability, you need to give a credit to the extent of the fair value without making any adjustments of TC. At the time of restructuring, the TC will not be allowed to be adjusted again. The new liability recorded at a fair value, any balancing figure gain or loss arises on extinguishment accounting will be taken to the P&L. And as far as the TC is concerned, that's going to be taken in the profit and loss immediately. So I think a few things which I like to pinpoint before we go further, because these are certain crucial issues to be kept in mind. So what are the crucial issues? Can I say when you apply the concept of three-step model to decide extinguishment accounting or to decide a modification accounting, what is important is that in the first two steps, you need to consider the original EIR. That is one thing. So one crucial point to be kept in mind is the present value is computed on the basis of the original EIR. Second, when you go to the step number 2, you need to remember that you should include the TC as well as a part of the cash outflows. You're going to consider the new terms for the interest and the principal. So apart from the principal and the interest, remember that you need to take care of the total outflows, including the TC as well. This is one caution. Second, when you decide that you're going in for an extinguishment accounting, once after applying the 10% test, you decide that we're going in for extinguishment accounting, then in that case, a financial liability will get derecognized at a book value. And the new financial liability will get recognized at a fair value. But remember, don't consider the TC, don't net off the TC at this stage. So you need to be careful that in the 3 steps, you're taking care of the TC. And in this case, the TC will not get readjusted. The balancing figure in this particular entry on a derecognition is going to be taken in the P&L. And then as far as a TC is concerned, you're going to separately put the TC in the profit and loss account. It's going to be immediately expensed. The transaction cost is going to be immediately expensed. So these are certain key considerations which you need to keep in mind when you apply the 3-step model and when you apply the extinguishment accounting. Right, friends. So I think that gives us a little good clarity of thought on one kind of accounting. I'm now yet to cover the concept of modification accounting with you. But I think before that, let's give you a break as well to relax your minds. And then I'm going to come to the concept of modification accountings with you. Okay, I think when you said, so can you explain a 5.4.1 part B of the study material? 5.4.11. 5.4.11. Let me just check which one you said. 5.4.11 part B. It's legally released from the primary responsibility. Okay, well, this is a case, that it's, in simple words, I would say it's a case of full and final settlement. So we can say that, if in a normal situation, you pay off your creditor, it's the clause A. And if it is a case where, you do a full final settlement, your creditor is willing to give you a discount. Let's say you owe him 10 lakh rupees and he says, okay, you can pay me, let's say 9.5 lakhs in a full and final settlement. So he is legally released from the primary responsibility. It says either by the process of law or by the creditor. So that means I tell him that, okay, he tells me, okay, I give you a discount in terms of things. So in simple words, it can be called as F&F. That's what we call a full and final settlement, right? And Kaushik, you said, so will we calculate the new EIR if the TC was present in the step number 2? No. In terms of the step number 2, you are not considering any new EIR. Your 10% materiality test is all based on the original EIR itself. It's not going to be based on the new EIR. It's only when you do the entry for the extinguishment accounting, at that stage, you need to consider that the new liability is being recorded at the new EIR. So now the new financial liability will be unwinded. You can say the finance charge will be unwinded using that 11% rate of interest. So in 10% materiality test, we're only interested in the variations of the cash flow. So in step 1 and 2, you're taking the same discounting rate. By considering the same discounting rate, the idea is only to see what is the variations in terms of cash flow, right? Okay, so I guess so far so good on this, friends. So I think time to now give you a little break for 10, 12 minutes time. And then I join you back and we'll do the concept of the modification accounting with you. So see you after the break. Welcome back, friends. So I hope you had a mental rest as well. Now I think let's take you to the next phase of accounting. And that is, if the 10% test fails, that means the variation is below 10%. Then in that particular case, we said we're going to apply a modification accounting. So I think let's take an illustration with you with reference to that as well. So there is a similar example after that, example number 3, wherein the concept of modification accounting would apply. So let's have a look at this example 4. That's on page number 12.166. So let me just read the example number 4. And we'll first apply a 10% test in order to decide whether it is a case of extinguishment or a modification accounting. It says on 1st January X0, XYZ issues a 10-year bond for 10 lakh, bearing an interest rate of 10% payable at the end of each year. Then he says the bonds are redeemable on December X9, that's a period of 10 years, for 10 lakh rupees itself, and there is no cost or fees incurred, so no TC, no processing fee. The effective interest rate is therefore at the rate of 10%. And then it says on 1st January X5, after 5 years, the bondholders agree to modification as under. No further interest payments are to be made, and the redemption continues to be the original date, and now the amount is going to be paid 16 lakh. And we given a legal and other fees incurred is 50,000. So first of all, we need to decide in this particular case that whether it is a case of a modification or an extinguishment accounting. So we're going to apply a 3-step model again in this case and take a call. So example number 4, which is given on page number, let me just write down the page. So example number 4 on page 12.166. Example number 4 on page 12.166. So at the first instance, let's apply a 3-step model and calculate whether the 10% test is passing or failing in this case. Now, first of all, in terms of calculating the present value based on original terms, I think it goes without saying that in this particular case, it would be undoubtedly 10 lakh. Even if you want to calculate the remaining cash flows based on original term, you're going to get 10 lakhs itself. And based on the new terms now, the new term says that there will be no interest payment, though the principal will be repaid at the end of the same maturity date. So after another 5 years, 16 lakhs is supposed to be paid. So we're going to consider the discounting of 16 lakhs at 10% at 5th year end. So if we take the factor at 10%, that is after a period of 5 years, I think it's 0.6 to 1. And we also need to consider the processing fee and the transaction cost, which is incurred, rather I would say the TC. So 16 lakhs is the only payment based on the new term plus the TC. So this comes to 1043,600 is the total payment. So now if you look at the variation in terms of percentage in step number 3, the variation is to the extent of 43,600. And this is over the base of 10 lakh rupees, that is in step number 1. So if we calculate this as a percentage, 43,600 by 10 lakh, it comes to 4.36%. And this is below 10%. Now, since it is below 10%, it would immediately indicate that we are applying the concept of modification accounting. Because if you pass that 10% test, then in that particular case, we're applying an extinguishment accounting. Otherwise, we apply a modification accounting. Now, if you look at the standard Ind AS 109, it is silent with regard to what kind of accounting would apply to modification accounting. So there are 2 approaches on the basis of which a modification accounting can be done. So I'm giving you the easier approach, which can be followed if a modification accounting applies. Very simple. Now, since the variation in this case is below 10%, we don't need to extinguish the existing financial liability. The only thing we need to do is that we've incurred a TC. So since the materiality levels is below 10%, we are allowed to adjust this TC as a part of the carrying value of the liability. Unlike extinguishment accounting, where a TC was not allowed to be adjusted. It was taken as an expense in the P&L immediately. But if a modification accounting is applicable, the TC can be adjusted to the carrying value of this financial liability. And I think needless to make a mention that the moment you're going to reduce the TC from the financial liability value, I think let me ask you, what do you think is going to get triggered? I think by now you know it very well that the moment you adjust a financial asset or a financial liability on account of TC or on account of processing fee, it immediately triggers the need to calculate the new effective interest rate as well. So immediately the company will have to calculate the new effective interest rate as well. And in order to calculate the new effective interest rate, you can think from a perception of an investor. So we can say that from the point of view of the investor, if you look at the cash outflow, I would say the cash outflow is now 9.5 lakhs because the book value of the liability was 10 lakh rupee. You made a reduction to the extent of 50,000 on account of the TC. So we can say the net fair value in the books of account is 9.5 lakh. And if you look at the inflow, we can see the inflow is going to be 16 lakhs at the end of 5th year. So now you need to basically get a discounting rate at which the present value of this 16 lakh will equal 9.5. So you need to basically do a hit and trial method and calculate when does the present value of 16 lakh rupees will equal 9.5 lakh. So I'm not doing that calculation, but if you do the interpolation, use a hit and trial technique, you're going to get an effective rate of interest at 10.99%. So by applying an hit and trial technique, we'll be able to get that at 10.99%, the present value of 16 lakhs will equal 9.5 lakhs. So thereafter, after this entry financial liability to bank, the financial liability will now be carried out at an amortized cost accounting where the unwinding of the finance charge will take place at the rate of 10.99%. So that becomes a very pretty simple and a straight accounting. So which means that if we go in for a 10% test and we conclude that there is an extinguishment accounting, you need to derecognize the existing liability, recognize the new liability at a fair value without taking TC, and the TC will be immediately taken to the P&L. But if you say it is a case of a modification accounting, then you are allowed to adjust the TC in the existing liability itself. But adjusting the liability for the TC would immediately trigger the need of calculating a new effective interest rate as well. Right, friends. So I think so far so good. This is the concept of, you can say, derecognition of financial liability. So I've covered with you the aspect of derecognition of financial assets, and I've covered with you the aspect of derecognition of financial liability. Now comes the other area of discussion with you, and this is with reference to the 3 special agendas now. Okay, I think there's another question. Okay, no, Manu, you said EIR. Okay. Okay, now I'm coming to the last 3 agendas in the standard. One is the aspect of embedded derivative. The next is the concept of impairment, and then the concept of hedge accounting. So I'm going to take these agendas in the same order. I'm going to first of all discuss with you the concept of embedded derivative. Then I'm going to come to the concept of impairments and then the concept of hedging. Fortunately, unfortunately, if you consider impairment has just come once, just recently in November 22 exams, not before that. And hedge accounting has never come in the exams, but still we need to do it. It's part of the study material as well, though there was one small question which was given in cash flow hedge accounting in the RTP. And even in terms of embedded derivative, there has been, I think, 1 or 2 questions which have come so far. So I think if you look at the frequency from the examination point of view, it may not sound much, but yes, they are still important because, as I said earlier also, don't go with the trend of the last 4-5 years that 2018, the new paper started. and we consider that to be a trend in terms of what's going to come in the exam. But yes, if you consider the previous part, I think the core area from where the examination paper comes is already covered. So I think we're safe to that extent, but nevertheless, please don't ignore the remaining portions as well. Okay, now I think let's come to the discussion of, first of all, derivative and embedded derivative. Now, as far as a derivative is concerned, we've already seen earlier that derivative has got a total of 3 characteristics. When I was doing Index 32 with you, I had already exposed you to the 3 parameters of a derivative. And just to remind you, I gave you that the 3 parameters of a derivative is, number 1, the value of the asset, the value of the derivative depends upon the underlying asset value. Second, there is no initial investment, it's either negligible or it is supposed to be 0. And number 3, there is going to be a future settlement of this contract. The settlement of this derivative takes place at a future date. So if you're able to fulfill the 3 characteristics, then in that particular case, we say that it is a derivative. And the moment you say it's a derivative, I also gave you that the accounting of a derivative is always done at FVTPL. So the accounting is always done at a FVTPL. So let's do one thing. Let us first, I think, do a plain vanilla question on accounting for a derivative. I'm not talking of embedded derivative. I'm going to do a plain vanilla question with you, which is going to be giving you an accounting of a pure derivative. Then after that, I'm going to expose you to the concept of an embedded derivative. So let me now come to the study material. And we are now taking a switch over to the unit number 4. Let me remind you, we covered the unit number 1 and then the unit number 3 simultaneously. Then I covered the unit number 2. Then I covered the unit number 5. Now I am on unit number 4, and the unit number 6 is on hedge accounting. So I've just covered them in a little different order. First unit 1 and 3, followed by unit 2, then followed by unit 5, and then unit 4, and then unit 6. That's how I have covered your financial instruments. So let me now take a small little illustration, which is on the aspect of a derivative accounting. There are a few questions given in the study material to begin with, where they've asked you to identify, in this particular case, is it a case of a derivative or not? So I think instead of coming to that, I am directly coming to accounting part. Okay, I think I need to share the question. It's not there in this unit. You'll have to probably open the comprehensive illustration part. So let me just open the comprehensive illustration part. This is the last unit in the financial instruments standard in the study material, where there are a few comprehensive questions given. So there is one particular question which is given on a pure derivative accounting. Yes, here it is. This is illustration number 3. And this is given on page number 12.197. It's page 12.197. In the comprehensive illustrations, page 12.197. Comprehensive illustrations in the study map. Okay, let's, I think, read this to you. It says on 1st January X1, Sam agreed to purchase 20,000 USD from JT Bank in future on December X1 for a rate which is 68 per dollar. So Sam company entered into a contract where they are going to buy the dollars at the rate of 68 per dollar. It's a contract to be settled in the future. Sam company did not pay any amount upon entering the contract. So I think 2 features are very clearly visible. Number 1, that there is no initial investment. And number 2, there is a future settlement. And in any case, I think we can definitely say that the value of this contract is getting derived from the exchange rates which are prevailing in the market. So I think all the 3 parameters, conditions of a derivative are present. So it would be a case of a derivative. Then he says Sam is a listed company and prepares the financial statements on a quarterly basis. So that means from 1st January X1, I would be making my financials for the quarter ending 31st March. And I would say if you're following the financial year, that is April to March, that also becomes the annual reporting period as well. So your accounting will take place on 31st March, which is the balance sheet date. And then since there is a quarterly reporting, the next would be 30th June. And then if there is any settlement dates, we'll see that as well. So we can say it's going to be 31st March, then you can say 30th June, then it is 30th September, and finally on 31st December. So we are given, for the purposes of accounting, please use the following information representing the mark-to-market fair value of the forward contracts at each reporting date. So he's already given you the status that if you square off the particular transaction, what is the gain or loss? He's given you the position on March X1, on 30th June X1, and on 30th September. And then he gives you a spot rate, which is prevailing on December X1. Now, in order to do this question, I think the easiest way to crack this question is to make a time scale. So what I'm going to do, first of all, to begin with this, I'm going to make a time scale and note down the various rates on different dates. So let's consider this as a time scale. We're sitting on 1st January X1, and the balance sheet date is March X1. The next balance sheet date, quarterly listing, is 30th June X1. Then the next date is 30th September X1. And then the next quarter ending is December X1. So I think let's note down the information on the rate of exchange. I am first of all given that you agreed to purchase $20,000 at the rate of 68. So you entered into a contract to buy. You entered into a contract to buy. So the rate at which you entered the forward contract was $68. And then I'm given the other movements as well. It says the forward rates on March X1 gives me a position -25. I'm just noting the data. Then it tells me on 30th June, it is -15. And then on 30th September, it's +12,000. And then I'm given the rate, which is prevailing on spot rate on December X1. It is $66. This is the spot rate, not the forward rate. Now, I think let's first of all understand what information is given so that we can easily do the accounting as well. So let's, I think, tell you first of all. Considering that, of course, you know the concept of squaring off, which you might have done in financial management, in strategic financial management, we can say, let me say something, vouch me. Can I say on 31st March X1, I would ask myself a question that you entered into the contract to buy, and if you sell at this stage, what is going to be the gain or loss? Is that right? In terms of a derivative contract, to calculate the profit or loss on sale, you need to put across a question that you entered into the contract to buy. So if you're going to sell on 31st March, then what is the difference between buying and selling? It seems that he's given me a loss of 25,000 rupees, which means you are going to buy at more rate and you're going to sell at a lesser rate, and it would become a loss on 31st March. Is that correct? I put that once again. Can I see he's given me the position after squaring off? This 25,000 is the position which is given after doing a squaring off. How do you do a squaring of the transaction? Originally, we entered into the contract to buy. So when on a balance sheet date, you do a squaring off, you need to take an opposite position. So you would say, okay, if I buy at the rate of 68, then you will sell at the rate which is prevalent on 31st March, a forward contract on 31st March, which would settle, which would have the same maturity date as the original contract. Because when you entered into the forward contract on 1st January, you looked at the forward rate, which is expiring on 31st December. Then on 31st March, you would ask yourself that if you were to enter into a forward contract expiring on the same maturity date, that is on December X1, what is the rate at which we can sell? He gives me the figure of 25,000 rupees loss, which indicates that you're buying at a high rate and you're selling at a low rate. So there is a loss arising on squaring off. Absolutely. So what do we do on this particular date? So we can say the entry which I'm going to pass on 31st March X1, there is a loss since we are recognizing it at FPTPL. You're going to record this loss in the P&L, and the corresponding derivative financial liability will be recorded at 25,000. Simple and straight. Then we go on to the next date, that is on 30th June X1. Can I say on 30th June X1, he did the same thing. He must have calculated that if you square of the transaction, what is the gain or loss? So there is a loss to the extent of 15,000. Now remember, this loss is supposed to be a cumulative loss. This is a cumulative loss. If this is a cumulative loss, we need to see that from a loss of 25, it's got reduced to 15. So that means in the addition, if you compare the addition, there is supposed to be a gain to the extent of 10,000. You need to consider that there is a gain to the extent of 10,000 because this 25, this 15, and this 12 are the cumulative positions. If they are the cumulative positions, we've already recorded a loss of 25, but now the total loss stands at 15. So there is a need to recognize a gain to the extent of 10. Now, when you recognize a gain of 10, if there was no financial liability, I would have created a financial asset. But since there is an FL, instead of recognizing a financial asset, you're going to derecognize the financial liability to the extent of the 10. So we're going to give a credit to the profit and loss account and give a debit to the financial liability. That's how the financial liability after this entry will stand in the books of accounts at 15,000. Then again, we go to the next date. On the next date, on 30th September X1, we are getting now a gain of 12,000. This is the cumulative position of 12. So would you like to tell me what is the total gain now? From a loss of 15, you stand at a gain of 12. So from a loss of 15 to a gain of 10, this means a total gain to the extent of 27,000. There's a total gain to the extent of 27,000. So what do you need to do? You need to pass an entry derecognizing the remaining financial liability of 15, recognizing a financial asset to the extent of 12, and you would record in the profit and loss account the entire gain to the extent of 27. So we are given a cumulative loss and a cumulative gain position. You keep calculating the incremental gain and the incremental loss to be booked at each stage. So these are the entries done on 31st March, on 30th June, and on 30th September. Now finally comes the position that is on December X1 when you made a final settlement of the contract. Would you like to now tell me what is the gain or loss? Can I say 68 is supposed to be the rate at which you buy and 66 is the rate at which you're going to sell? So what we're going to do now, we're going to pass a net entry. So on December X1, that is on the date of settlement of the contract, what we can do, since we're going to cash settle, assuming that we're going to do a cash settlement in this case, so I will give a debit, and I will give a credit of bank. Since you want to make a settlement, so what we're going to do in this case, we entered into the contract to buy $20,000 at 68. So you've entered into the contract to buy 68 rupees a dollar, $20,000. But when you square off the transaction and you net settle, then the spot rate is prevailing at 66. So this is the entry bank to bank, that is a cash settlement. So you bought at 68 and then you sell at 66. So this is bank to bank. Next, there is a financial asset which is standing in the books of accounts. You need to remove that financial asset from the books of accounts, and that is standing at 12. So the financial asset is standing in the books of accounts at 12, and then whatever is the balancing figure at this stage, that's going to be taken in the profit and loss account. So if we consider the balancing figure 20,000 into 68, so we can say this is going to be a total of, I think, 52,000, I guess, is the balancing figure. This will be taken in the profit and loss account. So the entry at the time of final settlement of the contract will become bank debit with the money received on the sale, and PL gets a debit balancing figure. The bank gets a credit to the extent what you pay, and the financial asset in the books of accounts is being cash settled. So that would also be derecognized at this stage. Now, there is a small little thing coming to my mind. I think let's ask you this particular question and you can vouch me on this. Okay, Kaushik, you said, so can't understand the sale rate is of quarter ending or not. And Sumiti said, is it always cumulative? And Kaushik, you got the same question. Why are we saying it's cumulative? Okay, let me, I think, just give the position back once again. Let me consolidate the picture to you. Okay, let's, I think, calculate. Let me take a different example to illustrate this concept to you so that we get a little more clarity on this. Now, watch this before I consolidate the solution to you. Let's say this is quarter end 1. Let's say this is quarter end 2. Let's say this is quarter end 3, and so on. Now, you entered into the contract to buy. You entered into the contract to buy at the rate of 68. Now, I would say that, okay, if you square off the transaction, what is the rate at which you sell? So I'm taking arbitrary figures. So let's say you're going to sell at the rate of 65. You say that you're going to sell at the rate of 65, or let's say at the rate of 67. Let's consider you go to sell at 67. So you buy at 68 and you sell at 67. So what is the amount of loss? It's 1 rupee a dollar. And the contract is for $20,000. So you get a total loss of 20,000. I think makes complete sense. Next. Now, there are two ways in which you can do the calculations in the quarter 2. Watch me carefully. Watch me carefully now. I'm doing the first time. I said I'll buy at 68. And let's say if you sell, now the rate is, let's say, 65. So there is a loss of 3 rupees a dollar into $20,000. We can say the loss is 60 in total. Is this the cumulative loss? Yes, it is the cumulative loss. You already booked 20 at the end of first quarter. So what do you book at the end of second quarter? Another 40. What you book at the end of second quarter is another 40. Now, there is another way of doing the calculations. Instead of taking 68, you've already taken 67. So let's take this as a base. Let's take this as a base. So you say that I'm going to buy at 67 and you're going to sell at 65. So there is a loss of 2 rupees a dollar. So we get a loss of 40. Now, this is not cumulative. This is not cumulative. Now, if the examiner gives you a position after squaring off, I will assume it's a cumulative position. But if you're doing your independent calculations, you are free to do any kind of calculations you want. If you consider the initial rate of 68 and then square off every quarter end, you're going to get a cumulative position. But if you're going to consider the rate at the end of first quarter as the base to the second quarter, you're going to get independent gain or loss in the given quarter. Similarly, if you watch me in quarter number 3, I've got two options. Either I take the same rate 68 as a base, and let's say now we decided that the rate went to 64. So we can say the loss is 4 rupees a dollar. That means there is a total loss of 80. If there is a total loss of 80, now you can say from 60 to 80, there is another loss of 20 to be recorded. Or alternatively, you can take the 65 as a base. And then you will get a loss of 1 rupee a dollar, and that's going to be a loss of 20. So you directly get that 20 itself. So it all depends upon how do you do your calculations. That do you compare the original rate every time with the rate at the end of each quarter? If you compare the original rate of 68 at the end of each quarter, you're going to get cumulative gains or loss position, and you'll have to calculate the incremental gain or loss positions at each stage. Now, if you come back to the question, it says, for the purposes of accounting, please use the following information representing market-to-market fair values at each reporting date. Unless mentioned otherwise, if he gives you the net position, 25,000 loss, 15,000 loss, it indicates the total losses at each date. That means these calculations will always be based on a cumulative impact, comparing 68 versus the rate at the end of March. Comparing 68 versus the rate on 30th June. So they will always be a cumulative position. So we can say on 31st March, the loss is 25,000. Then you would say on 30th June, the loss is 15 cumulative. That means there must have been a gain which arose to the extent of 10,000 between March to 30th June. So the total losses is 15. So you need to book a gain of 10. Then from negative 15, it is 12. It's a cumulative figure of 12. So that means from 15 negative to 12 positive, it's a gain of 27. So you need to book a gain of 27 in this case. I guess you got your answers right. I guess you've got your answers. Clear, wonderful indeed. So in this particular case, that's how I've taken the set of entry. Now, if I come back, so what I did, I first of all booked a loss of 25. Then I said there is a loss of 15, but technically in between the period, there is a gain of 10. Then I said there is a loss to the extent of a gain of 10, but cumulatively a gain during the period must have been 27. So when there was a loss, I recognized a financial liability. When the loss went down, I derecognized the financial liability. When the loss further went down, I derecognized the remaining financial liability and I recognized a financial asset as well. So this financial asset, which is now standing in the books of accounts on December at the time of net settlement, will be finished. So the financial asset is given a credit in this case. Now, I think if you've understood this concept, I think I would like to say something. If this clicks to you, then I think you've understood the concept very well. I think let me talk like a layman instead of doing that accounting. I understand one thing, that Sam company entered into the contract to buy dollars at 68. And then they squared off the transaction at a spot rate of 66. So to my understanding, what I understand, that you are going to buy at the rate of 68, and then you're going to sell at the rate of 66. So you're going to get a loss of 2 rupees a dollar. So on $20,000, 40,000 loss will take place. So I think if you look at all the entries put together, I understand that there should be a debit in the P&L to the extent of 40. And there should be an outflow of 40,000 from the bank. So I believe my net entry should be P&L account debit 40 and bank account given a credit at 40. Let me see. Let me see if I look at the all entries put together. Can I say in the first entry, you gave a debit to the P&L 25. So P&L got a debit of 25. Then P&L got a credit of 10. Then P&L got another credit of 27, makes it 42. And now in this entry, you can see that the profit and loss is again, just missed this. So P&L got a debit of 25 and then it was a credit of 10. So there is a debit of 15. Then P&L got another credit of 27. So I think that makes it 12,000. That makes it a total of 12,000 credit. Then I gave a debit to the P&L 52. So 12,000 credit minus 52. My P&L is coming a net debit of 40. If you look at all the entries, the net effect on the profit and loss is 40, which represents the overall loss. Though we are booking that loss or gain in different time period, because a derivative is always measured at a fair value and it is mark to market margin at the end of each reporting date. But if you look at the overall position of all the entries put together, there is a loss to the extent of 40. Even if you compare the bank figures in this case, initially there has been no bank movement, but if you see the bank movements in the last entry, the movement in the bank is also, there is an outflow of 2 rupees a dollar into 20,000. So at the end of the day, if you want to match your answers, you would see that the net effect is profit and loss should be a debit of 40. Bank should be a credit of 40, because if you enter the contract at 68 to buy and you're going to settle at 66, then there is a loss of 2 rupees a dollar. So that should be the net result. I guess I'm pretty clear on this. Okay, so this is as far as the concept of a derivative accounting is concerned. Now let's take you further and understand the accounting for embedded derivative. Now, friends, for the remaining portion of the class, there is going to be some technical discussions. Now you're going to realize that the level has suddenly increased. You will say that, the mind is getting heavy. So I think I'm already, preparing you for that. So now what I'm going to speak with you for the next almost like 15, 20 minutes or so is going to be technical, but don't get worried. You will get the entire inputs on that. But let me, I think, first start with the concept of embedded derivative with you. So I'm coming back to the study material. And I'm coming back to the unit number 4. And in terms of unit number 4, I am coming to the concept of embedded derivative accounting. Now, hear me very carefully. This is a chart which is given on page 12.131. Wow. I've always been in a habit of translating the flow charts and certain concepts on a 3-step model. So what I'm going to do today as well, I'm going to convert this chart into a 3-step model for you. So that when you are looking at accounting for embedded derivative, you can apply a 3-step model and decide certain things. Now, hear me carefully. There could be chances in between that, you will get a little jhatkas. So don't get worried on that. You will get the entire concept, but in between there could be certain phases when you will say, sir, I am not able to catch up with the concept. So don't worry, you will be able to catch up with things. Now, hear me, first of all, very well. Let's understand a very simple example to begin with. Let's understand a very simple example of, let's say, a case which has got a derivative embedded. Let's say, for example, I want to buy a property, plant, equipment, and I'm going to buy this property, plant, equipment, let's say in my functional currency itself. Let's say I'm going to buy a property, plant, equipment, let's say at a functional currency itself. So let's say I entered into a contract today to be executed in the future. Mind my words very carefully, friends. Mind each and every word very carefully. So I entered into the contract today wherein I'm going to buy a PPE at a later date. So it's like an executory contract that you've entered into a contract today, which is going to be executed at a future date. And I'm going to buy this machinery at a functional currency and it's a pre-decided price. Let's say my functional currency is Indian rupee. So it's a pre-decided portion that I'm going to pay 10 lakh rupee. Do you think the cash outflow to buy this machinery will vary? Of course not. If you've entered into the contract today, and in this particular case, you pre-decided the consideration to be paid, there is no way that the cash outflows will change. You are going to pay 10 lakh rupees itself after the tenure gets over. So there is no question of the cash flows will get varied. Now, in the same example, let's take a variation. Let's take a case where a PPE is going to be bought at a later date. You've entered into the contract today. But you said that I'm going to buy this machinery at a later date. And let's say you're going to buy this in a foreign currency. Instead of a functional currency, you're going to buy this in foreign currency. And the foreign currency, let's say, you're going to buy this at, let's say, to the extent of $40,000. Do you think my outflows will vary? Do you think my outflows will vary in this particular case? Yes, it will. Since you are going to shell money in terms of Indian rupee, the money which you're going to pay in a functional currency will definitely vary. So you can say the rate of exchange in this particular case can make the cash flows vary in this transaction. So we say that this is a case of a contract which has got a derivative embedded in it. So we can say that in a contract, there could be a certain fact. I am saying, I'm using a little different language. I'm saying in a contract, there could be a certain fact which will lead to the cash flows being varied. Now, when there is that something, like in this example, that something is the presence of a foreign currency outflow. The presence of an exchange rate will influence the cash flows to vary. So it becomes a hybrid contract. Now, the standard setters decided that there will be certain cases where we need to segregate that embedded derivative. Now, it is very important, first of all, to understand why did these standard setters actually think that, we should remove that derivative content. Because unless you are able to appreciate the fact that why a derivative is to be removed, it's going to be very mechanical accounting. You're just going to realize that, okay, if this is a case of embedded derivative, this is how the accounting is done. But I think it is necessary to understand that why the concept of embedded derivative is applicable. So before I teach you anything, I think what I'm going to first of all come to the aspect is give you the inputs of why the concept of segregating a derivative in such cases arises. So let me do one thing. Let me just bring you back on the study material. And without even looking at this chart, we'll look at this chart not today, later. Let's, I think, first of all, take you to a very simple example. And let's understand that why the segregation of derivative is relevant. So there is a very simple little illustration which is given in the study material, and I'm going to take you to that study material illustration right away. Okay, let's, I think, have a look at the illustration number, not 15. I think I'm going to take you further, not 15 in the moment. Just a second. There is a very basic illustration which is given at the very start of the study material. So I'm going to take you to that particular illustration. I think it's in the comprehensive illustration. So let me come to the comprehensive illustration part, and let's take you to that illustration in this case. Oh yes, this is the illustration number 4. Let's have a look at the illustration number 4 with you. And we're just going to understand a bit part. Now, this is going to be slightly technical, so I may not be getting enough time to elaborate it completely, but don't get worried. The basic structure will become clear. It says entity A, it's got rupee as a functional currency. It enters into a USD, and that's to the extent of $10 lakh sale contract. The company has entered into a contract to sell, and it says it was entered on 1st January X1 with entity B, which has also got a functional currency Indian rupee, to sell an equipment. So company A entered into a contract to sell an equipment at $10 lakh. Now ask yourself a very simple question. Do you think for entity A, the cash inflows will vary? Yes. His functional currency is Indian rupee. So when he's going to get that 10 lakh rupees, can I say that 10 lakh rupees, depending upon the rate of exchange, which might be prevalent at that point of time, can I say would decide the inflows? So the inflow is not going to be fixed, but it will vary because of the change in the exchange rate. Now we given a spot rate on 1st January is 45. And we given a spot rate on 31st March, that is 57. So we given the rate when you entered into the contract and the rate on 31st March, and then we given a 3 months forward rate, which is going to expire on 31st January. And you're also given a 6 months forward rate. And then we're also given a spot rate on 30th June. Now it says something which we may not be able to appreciate at the moment. Assume something. Let's not read that. It says provide detailed entry in the books of A for accounting of such embedded derivative until the sale is actually made. Now, what we're going to do in this case, number 1, watch me carefully. In this particular case, I have not entered into any forward contract. Mind the words carefully. I have not entered into any forward contract. So, but the question is giving us the information about the forward rate as well. It is giving me information, but I have not entered into any forward contract. Now, let me ask you, if I would have entered into a forward contract, can I say my sale proceeds would have got predetermined? If I would have entered into a forward contract, my sale proceeds would have been predetermined at the forward rate, which I would have entered, but I did not enter into any kind of forward contract. So my cash flows is going to vary in this particular case. So the accountant suggested an accounting like this. Now watch this carefully, what I'm about to do. So in this particular illustration number 4, if I were to look at the accounting in illustration 4, it'll look something like this. I'm going to first of all write down the transaction that there is a sale of PPE in foreign currency. I've noted down the transaction, and I've noted down the transaction like this. For the purpose of segregation of derivative, logic will come later. So sale of a PPE in a foreign currency. I'm going to now write this transaction in such a way that the fluctuations vanish. So what I'm going to say, okay, there is a sale of PPE in functional currency. I use the concept of what I call a split accounting in order to record my transaction. So I first of all write down the original transaction, and I know the original transaction is a sale of PPE in a foreign currency. Due to the foreign currency, it will lead to fluctuations in the inflows. So I said, okay, let me write the transaction in such a way that the fluctuations will not happen. So I said that there is a sale in a functional currency, which means the inflows will be fixed. This means now the variations in terms of the cash flows will not take place. Now there is nothing in the contract which will make the cash flows vary. I repeat, there is nothing in the contract which will make the contract vary. That which is not there is called a derivative embedded. In this particular case, the cash flows were going to vary. The cash flows were going to vary. So what was that something in the contract which made the cash flows vary? It was the exchange rate which was making the cash flows vary. I said, okay, let me put the transaction that what would be your transactions if the cash flows will not vary, that you make a sale in a functional currency. But I am not making a sale in functional currency. I am not going to get Indian rupees after making a sale. So you need to now record a transaction in such a way that this notional receipt in functional currency gets offset. Since I created a transaction where I said I'm going to sell the PPE in functional currency, but I'm not going to get any Indian rupee. There is no actual inflow in terms of Indian rupee. So there has been a notional receipt which has got created in Indian rupee. Since there is a notional receipt which has got created, what I need to do to offset this notional receipt, you need to create a contract, a forward contract in such a way that it results in a notional payment of cash. It results in a notional payment of cash. I hope I'm making sense, friends. I know I might be speaking highly technical at the moment, but I guess I am making complete sense in this particular case, right? So coming back to the inputs, as I said, that the sale of the PP in a foreign currency would lead to the variations in the cash flow. So I want to create a transaction which does not result in variations in the cash flow. So I said, okay, let me do something. Let me consider that there is a sale of a PPE in a functional currency, but there is no sale in a functional currency. So it means I am only creating that there is going to be a notional inflow in terms of Indian rupee. So if you're creating a transaction that there is a notional receipt, you should now create a transaction where there is a notional payment of Indian rupee. How would a notional payment arise in Indian rupee if you were to enter into a forward contract? You should enter into a contract to buy dollars. If you're going to buy dollars, can I say in that case, it would result in a payment of Indian rupee because you will pay Indian rupees and get dollars instead. So you enter into a forward contract to buy dollar. So what we have done for the purpose of accounting, the logics will come later, friends, don't get worried on that. So what I've done, in order to segregate the accounting, we split the accounting into two portions. That there is a sale of a PPE in a functional currency, which will not result in the cash flows to be varied. But this transaction creates a notional receipt in terms of Indian rupee. So we need to offset that notional receipt by a notional payment. So we said, okay, let's think of a forward contract where it would result in a payment of Indian rupee. So if I say that I am going to buy dollars, then you will pay Indian rupees to the bank and buy dollars. So a notional receipt and a notional payment will get offset. Let me again tell you, I am technically not entering into any kind of forward contract as such. This is just a notion which has been created for the purpose of accounting. There is no actual forward contract which my company is entering into. Am I, friends, pretty clear with this particular transaction? Yes. I think let's do one thing. Let's try another example as well. Let's give you another example just to understand how we're going to do this. Don't worry, this will not get over right now, but we will get into more details in the next class with you on this. Now let's take it further. Let's take another example other than the illustration number 4, which I showed you. Let's say my company enters into a contract to buy. There is a purchase of PPE. There is a purchase of PPE in a foreign currency. There is a purchase of PPE in a foreign currency. So would this lead to the cash flows getting varied? Now, the money which you're going to make, money which you're going to pay to buy this PPE in a foreign currency will fluctuate because of the presence of that foreign currency rate in it. I want to now create an accounting so that this variation in the cash flow is accounted separately. It doesn't disturb my accounting. So I said, okay, I'm going to put it like this, that there is a purchase of PPE. I think you can definitely complete the sentence in a functional currency. I can definitely, complete the sentence and say that there is a purchase in the functional currency. Can I say this would not lead to variations in the cash flow? Now, I think let me ask you the question. If you can answer this, then I think you've understood this. Can I say a purchase of PPE in a functional currency is going to result in a notional payment? Because you are going to make a purchase in a foreign currency, but I'm saying that I am going to make a purchase in a functional currency. So this means that it will create a notional payment. There is going to be a notional payment in terms of Indian rupee. So I want you to suggest me what kind of forward contract should I enter into so that there is a notional receipt of Indian rupee. Give me a particular forward contract which will result in a notional receipt in functional currency in Indian rupee so that the notional payment and the notional receipt gets offset. So I'll have to think that should I sell dollars or should I buy dollar? If I sell dollars, can I say they will give me Indian rupee? So what should be the contract I should enter into for the purpose to offset this? And I think that's wonderfully said. So we can say we're going to enter into the contract to sell dollar. I know what you're thinking, sir, we understood, but we didn't understand the logic. Why are you doing all these things? Why are you segregating the element of a forward contract in this particular case? Well, as I said, the logics will become clear later. Because unless I tell you how the accounting has taken place, you'll not be able to appreciate the logic as well. But I think, let me put it in a nutshell now. Why are we doing this is something which is still pending. Don't get worried. That would be answered very shortly, not today, but in the next class. But let me now tell you what am I up to. When you enter into transactions which will make the cash flows vary. Now, let's get on to the point. If you go to the study material and you look at the definition of an embedded derivative, it says embedded derivative is a component of a hybrid contract. The two examples which I give you are a case of a hybrid contract. It says an embedded derivative is a component of that hybrid contract that also includes a non-derivative host. Buy a PPE in a functional currency is a non-derivative host. Sell a PPE in a functional currency is a non-derivative host. And it also includes a derivative, which is the element of the exchange rate movement. So you can say the transaction has got a non-derivative to buy, to sell in functional currency. And it has got a derivative embedded in it, which is due to the exchange rate, with the effect that some of the cash flows vary in a way similar to a standalone derivative. If you would have entered into a forward contract separately, it would have made your cash flows vary. Now, since this derivative is embedded in the instrument, which is hybrid in nature, it is also making the cash flows of the instrument getting varied. So in this particular case, the standard set has said that it is necessary to take that derivative out. Now you would say, so why is it necessary to take the derivative out? This is pending, friends. This is something which I'm going to discuss in detail in the next class with you. After we understand the accounting of an embedded derivative, you'll be able to appreciate why did these standard setters say that let's remove the derivative out of that particular hybrid instrument contract. Okay. But I think you've understood the technique, at least, that when you segregate the embedded derivative, you need to basically decide a split accounting. Record the original transaction, create a transaction with which the cash flows will not vary, and then think about that did the creation result in a notional receipt or payment? And accordingly, you create a contra notional payment or receipt so that you can create two contracts. One is a contract which is without a derivative, and one is a contract which is a derivative. Right. I think so far, so good. I guess I've made my point so far. Okay. Now, let me, I think, take it further. Now it's time to give you a little MCQ questions, friends, at this stage. I think we've covered quite a lot today, quite a lot of things today. Now let's give you some questions to try, for which I'm going to give you the answers, not today, of course, in the next class, but I think let's first share the 5 questions to you. Okay, so we are covering a variety of questions because we've covered the accounting for derecognition of financial assets, derecognition of financial liabilities, and a bit concept in terms of embedded derivative. So let me give you question number 1. Can I see if the 10% test passes, if the 10% test passes, in this particular case, I'm looking at the 10% test for a derecognition of financial liability. So if the 10% test passes, can I say in this particular case, it is a case of derecognition? It's a case of derecognition of financial liability. In other words, it's a case of, we can say, extinguishment accounting. You just need to decide true and false. So once you pass the test, it's a case of derecognition and it results in extinguishment of liability. Number 2. In case of financial liability, if the 10% test fails, that means the variation is below 10%, then it's a case of no derecognition. It's a case of no derecognition and it becomes a case of modification accounting. And it becomes a case of modification accounting. The financial liability is not supposed to be derecognized and it becomes a case of modification accounting. I'm pretty sure I would have started getting answers right away. That's right, Koshki. And that's right, Manani. Wow, wonderful indeed. Then number 3. Now, the third one is slightly tricky, that when you apply the 10% test, can I see in this case, the step number 1 and the step number 2. When you apply the step number 1 and the step number 2, you need to consider in step number 1 the original EIR. And you need to consider in step number 2 the new EIR. When you conduct the 10% test, you need to consider the step number 1 original EIR and in step number 2 the new EIR. Then the question number 4. Now, in terms of the question number 4, I am considering that if there is a hybrid contract, if you enter into hybrid contract, for example, to sell a property, plant, equipment in foreign currency, you enter into a hybrid contract to enter into a sale of a PPE in a foreign currency, then what do you need to do? The forward contract which you enter into, when it is a sale in a foreign currency, is that you're going to buy dollars. I mean to say the foreign currency, let's say, is in terms of dollar. So we need to enter into a forward contract in terms of buying dollars. And number 5, same case, you enter into a hybrid contract. And the contract is to purchase PPE. The contract is to purchase a PPE in a foreign currency, let's say dollars. So you enter into a contract to buy the machinery, let's say in a foreign currency, then the forward contract which you need to enter into for the split accounting is going to be sell dollars. So I think these are the 5 questions, and I'm sure I've started getting answers on that as well. Yes, I am. I think Rashmi, Shobham, Manini are already giving answers on that. I like it, Shobham. Wonderful indeed. So these are the 5 questions, 3 on a derecognition and 2 questions on the concept of hybrid, what have been the learning today. Right, friends. So I think now we are left with some portion of this derivative accounting to be illustrated to you, followed by the concept of impairment and hedge accounting. So next class on Saturday we meet, and that's the final class where we finish with financial instruments with you. But please do keep revising this on a cumulative basis. So just revise this standard very well, because once the standard gets complete, I think it's going to be very pertinent that you make a one consolidated revision to the standard. Because once you do a consolidated revision, I think the entire flow of things will get comfortable. And do practice all the illustrations and the comprehensive questions given with study material, and do some extra practice from the RTPs and the past examinations, NTP problems as well, so that you get a good hang in terms of things. Right, so I think let's see if there are any questions coming in. And okay, I think Shobham, thank you, sir, for a great session. Thank you so much indeed. And I think on that note, friends, it's time to bid goodbye to you, unless you've got some questions to ask. So I guess that's it. Doesn't seem to be more questions coming in. So I think it's time to, friends, bid you goodbye. So I'm going to see you on Saturday for the final version of this financial instruments. Thank you, take care, and goodbye.